The final tally is still going on, but of course the headline is that Mike Johnson, the Republican representative from Louisiana, does have enough votes to be the next Speaker of the House. Of course, he's a fairly new member to the House, being elected back in 2017, representing the 4th Congressional District in Louisiana, a lawyer by trade and someone who has always his entire career been involved in political activism, links to the Southern Baptist Convention and the Christian right, opposition to abortion, marijuana, and same-sex marriages, and of course, a huge confidant of the former president, Donald Trump, which is a big part of the reason he's going to be in that speaker's chair in just a moment. We want to continue that conversation a little bit later in the show, but we do want to turn back to some of the developments going on in the markets and beyond. Pleased to kick things off today with David Lebovitz, global market strategist over at JPMorgan Asset Management. And David, before we get into the meat of what's going on with the markets and the economy, I do have to ask you about the political theater in Washington. With the big consequence, at least for markets, was this idea that we would get to that November 17th deadline for this budget deal, and there would be no one in the House of Representatives to shepherd it forward.
So, that risk has been removed, right? There should, in theory, be somebody there who can help get a deal across the goal line. I think the bigger implication for markets of what we've seen here today is what the prior guest was just alluding to. There's more spending that's going to be loaded into the pipeline. And if you think about the big move that we saw in rates over the course of the past couple of months, some people tell me, well, it's about investors pricing in higher for longer. Some people tell me it's about better than expected growth. I think a lot of it has to do with the fiscal situation in Washington. And while we've seen some resolution here, the elephant in the room is still a very unbalanced budget, significant deficits in a non-recessionary economy. And this just adds fuel to that fire. And so I think that, the risk to rates stemming from this is arguably to the upside.
I'm glad you went there on the fiscal side. I mean, Bloomberg had a great reporting earlier this week, just kind of showing just how much the deficit is wide, just over in the last year or so. And during when times were good, which was when you think we would actually kind of reduce our deficit and debt, but that's a whole nother conversation. But it does get to the idea of whether that was what was really driving a lot of the volatility in the bond market, particularly on the longer end of the curve.
So, I mean, I think it's about a view of we're not headed back to zero. The Fed at some point will ease, but they're very unlikely to go back to where they were in the aftermath of 08 and during COVID. And so we're going to be in this environment where rates are higher for longer, right? We've all become very familiar with that term. And I think the risk here is when you look at what happens to net interest spending. As a share of GDP, that's going to be up a full percentage point over the next couple of years unless rates are brought back down. And so there's this tension brewing in the bond market where fiscal policy is very much the originator, but now you're in an environment where price-insensitive buyers aren't playing the role that they had in prior years. The Fed has stepped out of the market. We know what's going on with foreign buyers, particularly countries like China. That means that the bond vigilantes are coming back into play. And I think we can take down this increased supply. I mean, at the end of the day, treasuries are arguably a risk-free asset. The question is what price? And I think that the price is simply going to be higher than what's been the case historically.
Well, that's exactly what I want to ask you. I mean, you've seen, obviously, a huge repricing. Really, it feels like when we got the last refunding announcement early August, things have been pretty wild since then. When you take together, you have the fiscal situation, you have increased treasury supply, you have the removal of those price-insensitive buyers. Where is fair value on a 10-year yield right now?
So I think the question about fair value on the 10-year, it's easier to think about that in the longer term. And let's just assume that the Fed is still targeting a neutral policy rate of somewhere around 2.5%. What that says to me is that 10-year Treasury yields aren't going to stay near 5% where they are today, but they could arguably be closer to 4% over the course of the longer term. And that's, again, a very different environment from the one that we've been in over the course of the past 15 years, where I would argue rates have been kept artificially low due to, unprecedented monetary policy.
Well, let's walk this out a little further and say that, okay, the 10-year yield settles around 4% in the long run. What is the ripple effect across asset classes, particularly for the equity market, if that's the case?
So I think most people are familiar with the idea that higher rates mean you're discounting those cash flows at a higher level, and multiples, in theory, would need to come down. One of the opposing arguments to multiples have been high and are going to need to be structurally lower in a higher rate environment has to do with how the composition of the market has shifted. And this is actually something we spent a good deal of time talking about as we put together our long-term capital market assumptions, which came out last week. Given the tech-heavy nature of the U.S. market, arguably, I think that means that it can command a higher multiple over time. Again, unlikely multiple like we've seen over the past decade and the past couple of cycles, but I'm not sure we need to re-rate down to the long-run average. And I would argue that in a higher rate environment, cash flow is king. right? So those are businesses that are paying dividends. Those are businesses with operating cash flow, which is positive. Those are businesses which can self-fund, which, interestingly, are a lot of the big tech players. And so, the question that we're asking ourselves today is, yes, there's an impact on the multiple from higher rates, but if you're generating a ton of earnings, does that really matter?
David, it was great to have you here, and we need to get you back on a more normal day where we can have a little bit longer conversation about what's going on in the markets. David Lebovitz there, global market strategist over at JPMorgan Asset Management. But what you see on the screen right now for our viewers, you're watching Representative Mike Johnson make his way up there to the podium in the House of Representatives to be sworn in as the next Speaker of the House of Representatives. Remember, that seat had been vacated on October 3rd. After members of the Republican Party revolted against Kevin McCarthy, their leader, who had effectively struck a deal with the Democratic Party in order to keep the government open. That was the budget deal that took us to what is now a November 17th deadline. A November 17th deadline, Katie Greifeld, that is now squarely on Mike Johnson's shoulders.
And it seems like that is his focus, too. I mean, there's reporting out on the terminal that we've seen the nominee come forward with a plan to avoid that shutdown. We haven't necessarily gotten the details about that, but Johnson told reporters today, we're going to talk this over, build consensus in Congress. So that sounds like a man who is trying to maybe work here together and actually pass something.
Yeah, and to be fair to him, I mean, we do know based on the reporting that he was one of the folks who did actually propose somewhat of a stopgap bill. It wasn't a full budget deal, but it was something that would effectively allow for funding through next year so that give more time to negotiations. I guess my question, though, is, when you consider what effectively got Kevin McCarthy ousted, is he going to have enough flexibility to sort of make those decisions on his own? I think we should listen in right now here. I believe that's Patrick McHenry taking the gavel there. Mike Johnson shaking his hand and now stepping up to the podium to be sworn in as the next U.S. Speaker of the House.
Speaker Mike Johnson, Speaker Emerita Nancy Pelosi, Whip Clark, Chairman Aguilar, all of my colleagues in government on both sides of the aisle. It's an honor and a privilege to once again stand before you as House Democratic leader. From the very beginning of this Congress, House Democrats have made clear that we will find bipartisan common ground with our Republican colleagues whenever and wherever possible, for the good of the American people. And House Democrats have repeatedly done just that. It was House Democrats who provided a majority of the votes necessary to avoid a catastrophic default on our debt that would have crashed the U.S. economy and triggered a job-killing recession. It was House Democrats who provided a majority of the votes necessary to avoid a government shutdown that would have hurt everyday American. It was House Democrats who provided a majority of the votes necessary to secure $16 billion in disaster assistance for Americans whose lives have been devastated by extreme weather events. From the very beginning of this Congress, House Democrats have been governing for the people. We continue to look forward to finding bipartisan common ground whenever and wherever possible. House Democrats will continue to partner with President Biden and Senate Democrats to put people over politics. House Democrats will continue to fight for lower costs, better paying jobs, safer communities, and to build an economy from the middle out and the bottom up and not the top
You're listening
down.
right now to Hakeem Jeffries, the representative from New York City, speaking right now effectively what is now seems to be turned into a stump speech extolling some of the wins, he says, that the Democratic Party has done for that chamber of Congress. We should point that is the minority party in Congress, the Republican Party in control, and they have a new leader, that is Mike Johnson from Louisiana, who will be sworn in as the next Speaker of the House 22 days after Kevin McCarthy was ousted by his own party for making a compromise with those Democrats. We will check back in on what's going on the floor of the House of Representatives, but we do want to get back to our bread and butter here, and that is a focus on the markets and the economy. Shamik Dhar joining us right now, BNY Mellon Investment Management Chief Economist. Talk a little bit more about some of those economic conditions, if you will, Shamik, and of course with the backdrop of everything that's going on in Washington, the backdrop, of course, the geopolitical issues in the Middle East here. You still have an economy here in the U.S. and to a certain extent globally that still seems to be growing at a relatively healthy pace.
Yes, that's right. And that surprised a lot of economists this year. But it's clear that the U.S. economy remains pretty robust. The downside of that is that means it's probably going to take some time to get inflation back to target. And that's why I think, the higher for longer meme, if you like, has crept into bond markets over the past couple of months.
I am curious about this idea, though, when we talk about the burden, the fiscal burden, and how that feeds into the Treasury market. What is sort of the loop? Meaning, how does that then feed back into economic conditions? Obviously, if the government's paying more, that's less stimulus. But there's a whole sort of another section of this economy that I think would be somewhat insulated to that.
Yeah, I mean, I think, clearly we will get some kind of short, it will be stimulatory in the short run. There will be some kind of boost, if you like, to overall spending from the fact that the deficit is currently as large as it is. However, I think the bigger question now is fast becoming, what does it mean for debt dynamics in the medium to long term, particularly if interest rates on Treasury yields stay above the growth rate for a long period of time? You need a kind of credible fiscal plan, if you like, to put the debt back on a sustainable path. And so far, there hasn't been a lot of evidence of that. So that's going to be one of the bigger questions, I think, coming out over the next year or so.
Well, Shamik, even the idea of putting the debt back on a sustainable path, is that even a priority at this point, or will it be any time in the future? It seems like that's not even on the agenda right now.
Yeah, I'm not a political commentator, so I can't really sort of judge how that process is going. But I think the fact that yields have gone up and that it's becoming pretty obvious that debt interest is going to eat up a larger share of tax revenues, I think that may well focus minds over the next few years, and of course the next few months, and of course. There's always the outside risk of some kind of nasty debt moment that really causes minds at the political level to be focused. At the end of the day, what we need to see is a credible fiscal plan that ultimately puts the debt path on a sustainable, at least stabilizing trajectory. And that's going to involve some fiscal austerity at some point if interest rates remain above the growth rate for some time, as now looks likely.
Well, we'll see if we get there. Obviously, the U.S. government working through some nuances right now. But I'm also curious to get your thoughts on inflation, because I'm going through your notes and this line jumps out at me. Future inflation targets may be up for debate. Do you think the Fed right now is debating whether 2% is still realistic in this backdrop?
Probably not now, not at the moment. The reason for that is that they're hyper-focused on getting inflation back to target at the moment and retaining credibility with the bond markets, and I think that's the right thing to do. But remember, we spent a lot of time, economists spent a lot of time after 2008 asking exactly that question. Isn't 2% too low an inflation target? Because it potentially gets us into trouble more often than we'd like. And would another inflation target be more appropriate? I think that question will become live and return once we have got inflation back to target. So we need to get inflation under control now. But once it is there, I think that question becomes very live again.
I'm curious, Shamik, when the Fed sort of makes this decision that their fight, if not done, at least they've done enough to continue to sit by, to continue to watch here. What are the data points that you would look at, that you would hope that they're looking at, that would give them a better sense of whether they made the right decision?
I mean, anything that tells you about the emerging economic slack, really. There are lots of data points. There are lots of surveys in the US, particularly, are pointing to a relatively weak economy in Q4 and into Q1. The real hard data, particularly the jobs data, has been stronger than that. So there's a bit of dichotomy out there. We'll be looking at all the indicators, but I think essentially what you need to see is some kind of at least deceleration. Because it's partly because the economy has been so robust that inflation, even though it's coming down, remains well above target at the moment. And it could well be that last 1 to 2 percentage points is the most difficult hurdle to clear of all. So getting inflation back to 2 remains the priority, I think.
All right, Shamik, really appreciate your time today. Our thanks to Shamik Dhar, BNY Mellon Investment Management Chief Economist. Now, coming up on the close, Sam Bankman-Fried will take the stand to defend his actions in the collapse of FTX. We'll have the latest next. This is Bloomberg. Well, Sam Bankman-Fried will take the stand to defend his actions in the collapse of FTX. Now, this decision comes after a series of former colleagues described him as the mastermind of a scheme to defraud customers and investors. Joining us now with the very latest is Bloomberg's Max Chafkin. And Max, I guess, given his online presence up to this point, we shouldn't be surprised that he's taking the stand as well.
Not at all. This is somebody who has essentially talked his way into this position. Talked his way into becoming this kind of grandee of crypto when FTX was riding high. Part of his strategy, of course, was talking to everybody, was being super transparent on Twitter. And then on the way down, kind of the same thing. He was giving interviews, not just to media outlets, but to random podcast hosts and TikTokers and YouTubers. And so it's not surprising in a sense that he would also want to talk to the jury. We should say, though, this is not a strategy that typically works for criminal defendants. Yeah. It is not something that your average criminal defense attorney would recommend.
Certainly not. We should also point out some of those interviews he gave in the lead up to the trial ended up being used in the trial against him. That was also a one-sided conversation. He was telling his side of the story. He's going to go before a jury to tell his side of the story after several defendants, including 3 prominent defendants, basically pointed the finger at him and said, no, he was the mastermind.
Absolutely. And it's been very difficult. It isn't just that they are his best friends and closest, colleagues and confidants, his ex-girlfriend saying these things. It's also that there's been pretty overwhelming documentary evidence. We've seen, Google documents with his, his comments in them. We've seen text messages. We've seen this kind of long back and forth about the balance sheets. Sam Bankman-Fried's story was that he had no idea that the company that his hedge fund was borrowing money from FTX. But of course, now we know that there were numerous balance sheets that he was very involved.
Can I just ask a question that I'm sure you can't answer, but I'm going to ask it anyway, is why didn't he take a plea deal?
Well, I think what we've heard is that he wasn't offered one. Now, it's hard to know exactly what that means, and I definitely don't know enough about the nuances of plea negotiations to know if we should take that at face value. I do think when there is a plea deal, you sort of expect the defendant to give something up. The prosecutors would do it for a reason. And it's not clear what Sam Bankman-Fried, who was essentially at the top of this pyramid of FTX, would have to give to prosecutors in exchange for a lower sentence. I also think from the point of view of prosecutors, right, they see this as something really bad. Billions of dollars from regular people was lost, was squandered, potentially defrauded. And I think they feel it's important that, justice be brought to the fullest extent.
And looking at the reporting we have on the wire right now, he could take the stand as soon as Thursday afternoon. So we have a lot to look forward to. And I mean, when in this trial, zoom out a little bit for us. What kind of charges, what kind of jail time are we potentially looking at for Sam Bankman-Fried?
These are very serious charges. It's mostly around fraud, versions of fraud, but the amount of money that Sam Bankman-Fried is alleged to have taken means that the sentence could be in the decades. I mean, we're talking about potentially an effective life sentence for Sam Bankman-Fried if he were to get the maximum sentence. And on top of that, we have a potential second trial involving campaign finance violations and alleged bribery. So even if he somehow has managed to convince the jury to believe his story, he's not out of the woods.
All right, Max Shafkin, of course, we don't know how all this is going to end, but Bloomberg reporter Max Shafkin had a big role here in telling the story of how it all began and how we ended up here. And you can actually get a glimpse of that here with our new Bloomberg Originals feature-length documentary on the rise and fall of FTX and Sam Bankman-Fried. I believe it's called Ruin, Katie Greifeld.
Yeah.
And we talk about just the downfall here. And this is going to premiere tonight, we should point out, 6 p.m. New York time. There's a big premiere here in New York City. Are you going to go to this thing?
No. Well, I've been up since 3:30 this morning, so I'm a little tired. Are you going to go?
I won't spoil it for you, but I won't spoil it for you, but it doesn't end well for a couple of the players there. All right, stick with us. We got a lot more to talk about, including going back down to Washington, D.C. as we wait for the swearing in of the new Speaker of the House and some sort of confirmation here as to what the policy positions and the legislative movement is going to be. This is Bloomberg. And we're looking at right now Representative Mike Johnson of Louisiana, who was just elected the next U.S. Speaker of the House.
A couple of weeks on her knees in prayer to the Lord, and she's a little worn out. We all are. I want to thank our children, Michael and Hannah and Abby and Jack and Will. All of our children sacrifice. All of them do, and we know that. And there's not a lot of perks to being a member of Congress's kid, right? And so I want to thank all of your families as well for what they endure and what they've had to endure for the last few weeks. We've been here a while. Yeah. I want to thank my faithful mother, Jeannie Johnson, who bore me at the age of 17. And my brothers, Chris and Josh, and my sister, Laura, and all their families, and all of our extended family. In Louisiana, family's a big deal, and we got a bunch of them. I especially want to thank all the extraordinary people of the great state of Louisiana. We have never had a Speaker of the House hail from our state, and so they've been lifting us up. I thank the people of Louisiana for the opportunity to serve you in Congress, and I'm humbled by your continuous support. We will make you proud. To my colleagues, I want to thank you all for the trust that you have instilled in me to lead us in this historic and unprecedented moment that we're in. The challenge before us is great, but the time for action is now, and I will not let you down. I want to say to the American people, on behalf of all of us here, we hear you. We know the challenges you're facing. We know that there's a lot going on in our country, domestically and abroad, and we are ready to get to work again to solve those problems, and we will. Our mission here is to serve you well, to restore the people's faith in this House, in this great and essential institution. My dad, it was mentioned, my dad was a firefighter. He was an assistant chief in the fire department in my hometown of Shreveport, Louisiana, a little town in northwest Louisiana. On September 17, 1984, when I was 12 years old, he was critically burned and permanently disabled in the line of duty. All I ever wanted to be when I grew up was the chief of the fire department in Shreveport. But after the explosion on that fateful day, he nearly died, and it was a long road back, and it's changed all of our life trajectories. I'm the oldest of 4 kids. And my dad, he lived with pain all the rest of his life for decades more. And I lost my dad to cancer 3 days before I got elected to Congress, 3 days. And he wanted to be there at my election night so badly. I'm the first college graduate in my family. This was a big deal to him. And so it was several weeks after that. It was early 2017. It was my freshman term, and it fell to me to be in the rostrum one night to serve here as Speaker Pro Tem. I thought that was a big deal until I figured out that's what you do for freshmen late at night. And I think if my memory serves, Miss Jackson Lee was winding down one of her long, eloquent speeches. And not that I was not enraptured by her speech, but I looked up at the top of the chamber there, and I saw the face of Moses staring down. And I just felt in that moment the weight of this place, right? The history that is revered here and the future that we are called to forge. And I really was just kind of almost overwhelmed with emotion. It occurred to me in that moment, it had been several weeks, and I had not had an opportunity yet to grieve my dad's passing, and I just had this sense that somehow he knew. And I had tears come to my eyes, and I was standing here, and I'm wiping them away, and then it suddenly occurs to me, the late-night C-SPAN viewers are going to think something's very wrong with the new young congressman from Louisiana. It wasn't Sheila's speech. I'm sorry. I just knew in that moment that my dad, my father, would be proud of me, and I felt that he was. And I think all of our parents are proud of what we're called to do here. I think all the American people at one time had great pride in this institution, but right now, that's in jeopardy. And we have a challenge before us right now to rebuild and restore that trust. This is a beautiful country. It's the beauty of America that allows a firefighter's kid like me to come here and serve in this sacred chamber where great men and women have served before all of us and strive together to build and then preserve what Lincoln did refer to as the last best hope of man on earth. We stand at a very dangerous time. I'm stating the obvious. We all know that. The world is in turmoil. But a strong America is good for the entire world. We are the beacon of freedom, and we must preserve this grand experiment in self-governance. It still is. We're only 247 years into this grand experiment. We don't know how long it will last, but we do know that the founders told us to take good care of it. I want to tell all my colleagues here what I told the Republicans in that room last night. I don't believe there are any coincidences in a matter like this. I believe that Scripture, the Bible, is very clear. That God is the one that raises up those in authority. He raised up each of you, all of us. And I believe that God has ordained and allowed each one of us to be brought here for this specific moment in this time. This is my belief. I believe that each one of us has a huge responsibility today to use the gifts that God has given us to serve the extraordinary people of this great country, and they deserve it, and to ensure that our republic remains standing as the great beacon of light and hope and freedom in a world that desperately needs it. It was in 1962 that our national motto, "In God We Trust," was adorned above this rostrum. And if you look at the little guide that they give tourists and constituents who come and visit the house, if you turn in there to about page 14 in the middle of that guide, it tells you the history of this. And it says very simply, these words were placed here above us. This motto was placed here as a rebuke of the Cold War era philosophy of the Soviet Union. That philosophy was Marxism and communism, which begins with the premise that there is no God. This is a critical distinction that is also articulated in our nation's birth certificate. We know the language well, the famous second paragraph that we used to have children memorize in school, and they don't do that so often anymore, but they should. G.K. Chesterton was the famous British philosopher and statesman, and he said one time, "America is the only nation in the world that is founded upon a creed." And he said it's listed with almost theological lucidity in the Declaration of Independence. What is our creed? We hold these truths to be self-evident, that all men are created equal, not born equal, created equal. And they are endowed by the same inalienable rights, with the same inalienable rights: life, liberty, pursuit of happiness. That is the creed that has animated our nation since its founding, that has made us the great nation that we are. And we're in a time of extraordinary crisis right now. And the world needs us to be strong. They need us to remember our creed and our admonition. Turmoil and violence have rocked the Middle East and Eastern Europe. We all know it. And tensions continue to build in the Indo-Pacific. The country demands strong leadership of this body, and we must not waver. Our nation's greatest ally in the Middle East is under attack. The first bill that I'm going to bring to this floor in just a little while will be in support of our dear friend Israel, and we're overdue in getting that done. We're going to show not only Israel, but the entire world, that the barbarism of Hamas that we have all seen play out on our television screens is wretched and wrong, and we are going to stand for the good in that conflict. We have a catastrophe at our southern border. The Senate and the White House can no longer ignore the problem. From Texas to New York, wave after wave of illegal migrants are stressing our communities to their breaking points. We know that our streets are being flooded with fentanyl, and all of our communities, children, and even adults are dying from it. The status quo is unacceptable. Inaction is unacceptable, and we must come together and address the broken border. We have to do it. The skyrocketing cost of living is unsustainable, and Americans should not have to worry about how they're going to feed their family every week because they can't afford their groceries anymore. Everybody in this room should think about this. Here's the stats. Prices have increased over 17% in the last 2 years. Credit card interest rates are at the highest level in nearly 3 decades, and mortgage rates are now at a peak we haven't seen since 2001. We have to bring relief to the American people by reining in federal spending and bringing down inflation. The greatest threat to our national security is our nation's debt. And while we've been sitting in this room, that's right, the debt has crossed almost $33.6 trillion. In the time that it's going to take me to deliver this speech, we'll go up another $20 million in debt. It's unsustainable. We have to get the country back on track. Now, we know this is not going to be an easy task, and tough decisions will have to be made. But the consequences, if we don't act now, are unbearable. We have a duty to the American people to explain this to them so they understand it well. And we are going to establish a bipartisan debt commission to begin working on this crisis immediately. We all know that we also live in a time of bitter partisanship. It was noted, and it's been on display here today, right? When our people are losing their faith in government, when they're losing sight of the principles that made us the greatest nation in the history of the world, I think we got to be mindful of that. We're going to fight. We're going to fight vigorously over our core principles because they're at odds a lot of times now in this modern era. We have to sacrifice sometimes our preferences because that's what's necessary in a legislative body. But we will defend our core principles to the end. In his farewell address, thank you. In his farewell address, President Reagan explained the secret of his rapport with people. And I like to paraphrase his explanation all the time. He said, you know, they call me the great communicator, but I really wasn't that. He said,
Representative Mike Johnson of Louisiana, the Republican there, elected the next Speaker of the House, now giving a speech before his official swearing in, walking through some of the priorities that he will undertake once he is sworn in, making it clear his religious principles, but also making it clear that issues with the border and issues with the national debt and deficit need to be addressed and need to be done so quickly. Kelly Lyons, I believe, is still outside of the Capitol right now as Mike Johnson continues to speak. And Kelly, tell us a little bit more about this man who's going to not only just have to woo the party, but of course try to find some degree of compromise with his Democratic counterparts.
Yeah, and this is going to be a challenge for him, Romaine. To this point, until today, he had never really held a prominent leadership position in Congress. Yes, he chaired the Republican Study Committee, which is a very conservative caucus, but he hasn't held chairmanship of a full House committee. He hasn't been a member of House leadership, and now he is vaulted to Speaker of the House. That means he is going to have to be the one in the room negotiating with people like Chuck Schumer and Mitch McConnell in the Senate, maybe ultimately even President Biden himself, to try to get the U.S. government funded, to get appropriation bills passed, knowing we're facing a deadline here of November 17th, and of course also having to deal with things that are on Congress's plate at the moment, like that more than $100 billion supplemental funding request the White House has sent to aid not just Israel, which he mentioned here in the speech on the floor, but also Ukraine, Taiwan, and address border security, which is something else that Johnson has brought up. So it's going to be a challenge to address all of these things and to keep the conference in line. We have seen that borne out already with former Speaker Kevin McCarthy. This is not an easy Republican conference to deal with, and yet he was able to get them aligned enough to actually get him the Speaker's gavel today, and we'll see how much that momentum can carry him forward from here.
And Kayleigh, it was interesting to listen to Johnson's speech and kind of lay the groundwork for future negotiations, saying that we're going to have to sacrifice some of our preferences because that's what's necessary in a bipartisan body. Of course, also saying that one needs to defend core principles as well. But talk to us what's first on the priority list here. We know from reporting that he's put forward a plan to avoid a November shutdown. Do we know any of the details?
Well, he was a little bit fuzzy on the details when speaking to reporters this morning. I think he wanted the gavel in hand first before starting to actually iron out ultimately what that kind of proposal could look like. What he did acknowledge, though, seemingly, was that November 17th is not all that far away now, considering this body has wasted about 3 weeks with no speaker, unable to do anything legislatively, and they still have 8 appropriations bills that they need to pass. There likely isn't time to do that, and certainly not to reconcile them with the Senate, which may want these packages to look very different. And what that means is it will likely need to be a continuing resolution to keep the government funded beyond November 17th. What he suggested was that could mean the government is funded temporarily either until January 15th or April 15th. But he said that was something he's going to need to discuss with the conference. And we know that there are members of this Republican conference who have expressed that they don't want to be supporting continuing resolutions, as it is just kind of a kicking the can down the road. So we'll see if he is able to get enough of his conference on board with that idea. And then also, as he mentioned, it's likely going to take some bipartisan effort here, considering the Senate is still controlled by the Democrats. What we do know about Johnson, though, is ultimately he is likely to push for lower levels of spending. He is a conservative, not just socially, but on fiscal matters as well.
Yeah, definitely a cultural conservative. But you saw there in his speech, Kayleigh, definitely talking a lot here about, in his words, the greatest threat to national security, in his words, the nation's debt. Kayleigh lines outside the Capitol, inside the Capitol, the House of Representatives there. Mike Johnson taking a victory lap ahead of his official swearing in as the next U.S. Speaker of the House. Romaine Bostick here alongside Katie Greifeld. A focus here on the markets as well, Katie, and the markets that are under pressure right now. The NASDAQ now on pace for its second worst day of the year, down more than 2%, and the 10-year yield higher by 13 basis points.
Yeah, you've really seen a deterioration just over the last few hours. Of course, the S&P 500 and the NASDAQ 100 looking at session lows right now. It doesn't help that Alphabet shares currently down by almost 10%. Romaine, if that holds, that's the worst day since March 16th, 2020.
Some stunning moves in the market. A full breakdown when we come back. Stick with us. This is The Close on Bloomberg. Let's get a view from the sell side with our top calls. Big movers on the back of analyst recommendations. And we start with Gap, believe it or not. An upgrade over at Wells Fargo to overweight. Wells Fargo citing a compelling turnaround story for the clothing retailer, saying good inventory levels and a better grasp on costs are the key there. The analyst also says the hiring this year of Mattel executive Richard Dixon as CEO, that actually bodes well for Gap, given Dixon's role in revitalizing the Barbie brand. Gap shares up almost more than 6% here on the day. Next up, let's take a look at Etsy, getting a downgrade to neutral over at Citi, which also cut the price target all the way down to 67 from 114. Student loan repayments are pressuring consumers, and there's greater competition for other e-commerce companies. That's what the analyst says, and says that these headwinds are really going to impact sales growth in the near term. Shares down 3.5%. And finally, TransUnion, which dropped more than 20% yesterday, continuing to slide today as analysts adjust their recommendations. The credit reporting company, remember, cut its outlook for the rest of the year, and Bank of America has seen enough. A double downgrade on the stock to underperform from buy. The price target to a street low 44 from 95 bucks. Bank of America says it's hard-pressed right now to find any upside unless macro conditions improve. Ouch. Shares of TransUnion down 7% on the day, and those are some of our top calls. we do want to stay in the sell side space and push ahead to more earnings, and it's a big one. The market is really eager right now to hear from Meta, which reports third quarter results after the closing bell tonight. A lot to focus on, from AI, digital ad spending, and, well, how it's competing with the likes of TikTok and X and Snapchat and all the other social media sites out there. Michael Morris joining us right now for a preview, Senior Managing Director at Guggenheim Securities, and he's got a buy rating on Meta. And it's interesting, Mike, because we talk about kind of the two big tech companies we had yesterday with Microsoft and Alphabet, two stocks that are moving in different directions today. And I am curious whether the Meta earnings, the Meta results that we're going to get tonight, are they going to be more reflective of what we heard out of an Alphabet, or are they going to be more reflective out of some of the strength that we saw in Microsoft?
Well, interesting. I think that the company itself tends to be more like Alphabet, given its, the primary part of the business is, of course, an advertising-based business model, which is similar to Alphabet. One of the things that's interesting is that when we look at the earnings last night, advertising was probably the least of the concerns on Alphabet. I think there was more concern around levels of spending and some of the competition in the company's newer initiatives around cloud and artificial intelligence. If we think about Meta tonight, I'm expecting a very similar positive result in the context of areas of overlap. And so that would specifically be advertising and ad demand for the platform, where we think that advertising buyers continue to have very strong interest, in fact, accelerating interest in being on the platform, and some small successes around AI. The company will tell you AI has been part of their fabric for a long time. And what that does is drive more engagement, which I think is very healthy. And it also is starting to drive ways for advertisers to enhance their message on the Meta platform.
I am curious, too, about this idea of sort of where it does stand, all the properties that Meta has in the social media universe. I know it's kind of hard to just do it on an umbrella thing, because obviously Facebook is very different than Instagram, and even when you get into WhatsApp, which I guess technically is social media as well here. But where do they fit in that broader landscape right now?
Yeah, it's actually a great question. So there's a couple things. First of all, the company will report to us engagement on a family of apps basis. That engagement has exceeded 3 billion users and has continued to grow. And so we look for continued growth across the family. But to your question about kind of looking at a couple of the different parts, you have what I would call the more traditional usage of platforms like Facebook and Instagram, a bit of a lean back experience. That has been enhanced through services like Reels, which is a short form video service, which we believe continues to strengthen the engagement on the platform, or the time spent on those platforms. So that's great. More time spent means more ad impressions. More ad impressions means more revenue opportunities. You also referenced the messaging capabilities of the company overall, Messenger and WhatsApp. These are two services that have been used heavily and on a growing basis by consumers, but have been a little more difficult to monetize. And what we are seeing now is some of the early opportunities for the company to use those platforms to drive engagement between consumers and businesses. There's click-to-message opportunities as part of an advertising suite. And this is another growth opportunity for the business that we think is in very early days.
Michael, can we talk about Reels a little bit more? Because, I mean, are they managing to actually dislodge TikTok at all and take market share from TikTok? You think about engagement on the platform. Speaking personally, I somehow spend a lot of time on TikTok, and it seems like when I go to Reels, all of the content is coming from TikTok.
Well, that has certainly been a concern for quite some time now. And I think when you look back at Meta, when investor enthusiasm for the stock was at its lows, there was concern around spending and the company's investment into the metaverse, and a negative connotation as to what that meant for the core business. But there was also fear about the company losing share of attention to TikTok. I do think that we found a bottom on that. I think that Instagram in particular, but the company overall through its Reels platforms on Instagram and Facebook has grown relative share. So while TikTok is still the leader in short form video, I do think that the Meta family has really made progress and is a clear number 2 at this point with respect to engagement. And I think when you combine that with Meta's stronger platform for monetization, they're really coming from a strong place with respect to getting the right message in front of the right consumer at the right time. They are able to sort of supercharge the financial implication of strengthening engagement on the platform. whereas TikTok is coming from a place where they had a leadership position in engagement, and they're really trying to boost the monetization. So I like them. I think they're both doing well. They're coming from different places, but I do feel confident that Meta is making great progress here.
Michael, great to catch up with you. Michael Morris there, Guggenheim Securities. A closer look at Meta, which reports after the bell. Full coverage in just about an hour or so when those results are scheduled to hit. Meanwhile, we do want to go out to Detroit here and check in on what's going on in the auto sector. David Welch, our Bloomberg bureau chief, joining us right now. And David, we got a report just a little while ago from the Associated Press saying that apparently the UAW and Ford are a lot closer to a deal than what we had expected. What do we know?
They're pretty close, I think, and they kind of have been for a while, looking at 23, maybe a 25% raise, and I think that's what's probably being hashed out at the table right now. So they're pretty close on economic terms, and what I think will happen is whatever Ford decides to put forth as a final offer, the union will then shop that to General Motors and Stellantis, and presumably you could get a deal done with all three companies within a few days. But there are often hitches. People are telling me, be cautious here because there have been a lot of false dawns on this before. So, it's looking better and has been looking a bit better since Friday, but, it's been unpredictable.
Well, David, you touch on what I've been wondering. If we do get a deal between the UAW and Ford, does that put more pressure, make it much more likely that we'll get something through with the other two as well?
Yeah, they almost can't change the economics. It's just the way this has always gone, and the union wouldn't settle for a lesser economic package from General Motors or Stellantis. There could be individual differences in the contracts. Job security has been an issue with Stellantis. There's a plant in Illinois and another one in Southeast Michigan, an engine plant where the union has wanted some guarantees on work that would keep people employed over the course of the 4-year deal. With General Motors, it's battery plants because they're building those. They have a couple of those joint venture plants coming up sooner than the others, and they'll want some sort of framework for that. But once they get the economics in place, which is pretty much there with everybody, then they'll work out some of those issues.
All right, David, really appreciate your time and your reporting. Our thanks to David Welch, Bloomberg Detroit bureau chief. And of course, if you take a look at these markets, the S&P currently down by about 1.4%, Romaine. The NASDAQ 100 even more so. Yeah, and pretty significant too. Below that 4,200 mark, of course, which has been testing. We haven't had a close below that 4,200 mark since I think at least early May. So this would be significant, already below that 200-day moving average. And take a look at what's going on in the yield space here, a reawakening of that sell-off. Pretty breathtaking. I mean, you look at this 12-13 base move in the 10-year yield. What exactly is driving it? I'm not sure. Of course, we are in the Fed blackout period. It's really all about earnings right now. Yeah, more earnings coming after the bell tonight. Meta and IBM. Stick with us. This is The Close on Bloomberg. Just about 3 p.m. here in New York. This is the countdown to the close. Let's get a view from the top. I'm Romaine Bostick. And I'm Katie Greifeld. Interesting day here in the markets. We're right around session lows, but this is actually setting up to be a pretty ugly day, Katie Greifeld. And S&P down about more than 1% on the day. The NASDAQ down more than 2% on the day. And I guess that'll happen when you have a name like Alphabet lower by more than 9%. Worst day since 2020 it's shaping up to be. And you have Microsoft, of course, having a pretty good day. I'll get to that in just a minute. But it's not enough to really boost the benchmarks here. And it really feels like the wheels have just started to come off in the last hour or so. Sentiment really deteriorating. Yeah, really deteriorating here. And I get to this idea of whether earnings season really is going to be that boost that we see. Now, keep in mind the big jump that we're seeing in yields today. That might be playing a factor. 13 basis points on the 10-year yield. If you're looking for a bright spot, you can find it in the old boring insurance sector, but Philadelphia Semiconductor Index not participating at all. I'll flip up the board real quick because I do want to talk about that cyclical trade, particularly that small cap trade and the persistent underperformance that we've been seeing in the Russell 2000 relative to the broader market all year long. Right now, when you compare the two, the S&P versus the Russell 2000, that's lagging by about 15 percentage points right now, setting up for what could be the worst year of underperformance for the Russell going back to 1998. It's pretty amazing, and this is a theme I've kind of been obsessed with. And I mean, you think about this higher for longer environment that we've been living in, and the narrative that it hurts the large caps the most, those big tech names with those long duration cash flows, hasn't really played out. But you think about the refinancing risk for those smaller companies that have to tap the bond market all the time. They don't have enough cash to just fund their operations. It's really showing in the equity market.
And how many people have you had on this program that have talked about this? They're looking for quality names, and that means quality balance sheets.
And increasingly, that just means big tech. Of course, you talk about valuations, and it's a consideration, but it seems like those cash flows are really what's top of mind right now. But let's get to some of those big tech names. Got to start with Alphabet, because everything I just said doesn't really apply right now. Down by almost 10%. Pretty amazing. Worst one-day performance since March 16th, 2020. I don't know where you were on March 16, 2020. I was at my parents' house in New Jersey, because that was deep in the pandemic.
Oh, yeah. I was still working. I worked to the bitter end, Katie Greifeld.
I imagine you did.
And I survived.
Yeah, here you are. But obviously, that's a tale about earnings, and what we saw out of Alphabet, much different from Microsoft.
Well, what about, well, I mean, talk about Microsoft, because that is kind of the outlier here. I mean, they had a good quarter, and I think unlike Alphabet, they seem to have much more strength in their cloud business, and obviously it's a more diversified company too, so maybe that gives people more confidence heading into that name. And
I don't know how you felt breaking the earnings yesterday, around almost 24 hours ago, but
I live for that.
We were just talking about the cloud. It wasn't necessarily a conversation about AI. We were talking about some of the fundamentals of the cloud business here, kind of a back to reality moment.
All right. We're waiting to hear from the newly elected Speaker of the House. You see him there in the middle. That's Mike Johnson, the Republican from Louisiana. We will take you to his speech as soon as he starts speaking here. I'm told that he is going to make some remarks, and then he will take some comments from the press. See Steve Scalise and some of the other members, leadership of the Republican Party. Let's listen in now. I'm not quite sure who that is talking, but let's listen in.
As Speaker of the People's House. As many of you heard and the American people heard, I meant every word that I said on the House floor. I've had the opportunity to work with Mike Johnson as vice chair, and I was so humbled and honored to nominate him. Mike epitomizes servant leadership. He is humble, but he is strong. He is well respected, not only across this conference, but across this great nation. And we know the stakes. We know that we were sent here on behalf of the American people to serve as their voice, to stand up for them, to push back on the failed far-left agenda of single-party Democrat rule led by Joe Biden. So we are here unified in strength to reopen the People's House, and I'm so excited to turn it over to my colleague, Tom Emmer from Minnesota, our whip.
You're here. Thank you, Elise. Good afternoon, everyone. Good afternoon, everyone. Thank you for bearing with us. I know it's been a long few weeks. From an outside point of view, these last few weeks probably look like total chaos, confusion, no end in sight. But from my perspective, this is one of the greatest experiences in the recent history of our republic. While speakers' races for the last 100 years have been conducted behind closed doors, filled with political promises and tyrannical threats against anyone who would not fall in line, the speakers' races under our House Republican majority have been open, honest, transparent, and a true display of what democracy looks like in action. It took a while for us to get here, but our conference has shown that we achieved tremendous success when we worked together as a team. And I couldn't be more proud to be part of this team with our new Speaker of the House, Mike Johnson, leading the way. Mike is a strong man of faith, a constitutional conservative, and a fierce fighter for our Republican common sense agenda. He has been a leading force on the Judiciary Committee, where he has defended Americans' individual liberties while fighting back against the Democrats' radical agenda and the Biden family's culture of corruption. He has been an important leader in our conference for nearly 3 years as vice chairman. And as Speaker, I know Mike will keep our majority united as we continue to deliver on the commitments we've made to our constituents. We've had some challenging times around here these last few weeks, but our country has endured challenging times before. And I have zero doubt that we will again. Not only will we survive, we're going to come out stronger and better because of it. And the American people can be rest assured that with Speaker Mike Johnson at the helm, our House Republican majority will keep fighting to unapologetically stand with Israel, rein in Washington's reckless spending, secure our border, and force the Biden White House and Schumer Senate along with us as we govern. If these last few weeks have proven anything, it's that we will never stop fighting. We will never give up. And I firmly believe that with House Republicans now united and ready to get back to work, as our new Speaker-elect said, our best days lie ahead. And with that, I'm going to introduce the other legend from Louisiana, our Majority Leader, Steve Scalise.
Thank you, Whip. Well, this is a great day. This is a day that's been coming for a long time. You know, if you think about what's happened these last 3 weeks, while a lot of people outside of Washington talk about dysfunction, this great group of men and women behind me have been talking about how to fix what's broken in Washington. And hasn't that discussion been coming for way too long? That's what this last 3 weeks has been about. That's what we have been struggling through. That's what we've been working towards, and we resolved it today by electing Mike Johnson as our next speaker. And what Mike laid out was a vision. It wasn't just core principles that he talked about today on the House floor so eloquently, but a vision for how we get not just the House back operating, but how we get Washington working better, how we fix this broken institution, and how symbolic. Mike talked in the House chamber about the symbolism of the House chamber, Moses, In God We Trust, right above the Speaker's rostrum. So many other symbols, Washington, Lafayette, the history of some of the great battles, passing the 13th Amendment in that chamber. But if you look at this Capitol dome that serves as a beacon to so many, not just here in America, but all around the world, interestingly, the last 3 weeks, the Statue of Freedom was covered in scaffolding. Just like we have been doing construction to fix this broken institution, how symbolic that the scaffolding is now coming down as we elected a new speaker to fix this institution that's had problems for decades that needed to be addressed and went ignored for way too long. I have seen this man in action since I was a state representative. For those people that don't know Mike Johnson, maybe they're looking to Google, maybe they're looking to other places. But those of us who have known Mike Johnson for a long time, and I've known him maybe longer than most, I've seen a commitment, a self-service commitment to things bigger than himself, going back to my days in the State House and when he came to Congress. Those same principles followed him. His belief, his faith that drives him so deeply that some actually mock him for. Those are the principles that make this country so great. Those are the principles that cause people who believe in freedom all around the world to look up at that Statue of Freedom as a beacon of hope for all around the world. And what Mike Johnson is going to do for us and our country, getting us back on track. We are just getting started, but people are going to come to know and love what he represents because he fights for things bigger than himself and people who have been ignored for way too long. It is my great privilege to introduce the 45th Speaker of the House, my dear friend, Mike Johnson, the Speaker.
Thank you, Stephen, and thank you, Tom and Elise. This is an extraordinary team that has been assembled here to serve the American people. Steve Scalise represents so much in our home state of Louisiana. One of the things he truly represents is perseverance and hope. And as he was talking here just a moment ago, I was reminded of the scripture that says suffering produces perseverance, perseverance produces character, and character produces hope. What we need in this country is more hope. The people have lost their faith in our institutions. Their faith is at an all-time low. And one of the reasons they've lost it is because the Congress, over the years, has not delivered for the American people well enough. We're in the majority right now. We've gone through a little bit of suffering. We've gone through a little bit of character building. And you know what it's produced? More strength, more perseverance, and a lot of hope. And that's what we're about to deliver to the American people. We're going to speak with clarity and conviction and consistency to the American people. We're going to tell them what we're for, what agenda we are pursuing, and why it is best for every American, why it will give them more liberty, opportunity, and security. We're going to speak to that clearly. We're going to act consistently, and we're going to exhibit two things here: trust and teamwork. And this group will deliver for the American people. I said it in the chamber, and I will say it here. We're going to govern well, and I think the people are going to be very pleased with those results. We're so grateful. I'm so grateful and so humbled to have gotten a unanimous vote on the floor by all of my colleagues here. We went through a lot to get here, but we are ready to govern, and that will begin right away. You've all heard me talk a lot today, and I'm not going to belabor the point because the sun is bright and it's too warm for the fall. But I'll say this: we're going to dispense with all the usual ceremonies and celebrations that traditionally follow a new speakership because we have no time for either one. The American people's business is too urgent in this moment. The hour is late, the crisis is great. In America, we hear you. And we are reporting again, as I said in there, to our duty stations. That will begin in just a few moments. This entire group is going to go back to the House floor, and we are going to pass our resolution in support of the nation of Israel, our closest ally in the Middle East. You're going to see an aggressive schedule in the days and weeks ahead. You're going to see Congress working as hard as it's ever worked, and we are going to deliver for the American people. I'm grateful for this opportunity. I want to thank you for being patient with us, and I promise you it'll be worth it. God bless you. God bless you. It's good work.
And we were just listening there to Mike Johnson, the new U.S. Speaker of the House of Representatives. In his words, an aggressive schedule ahead in the days and weeks ahead for the House of Representatives, with a lot of unfinished business, including the first order of business, which he said he's going to walk back into that chamber right now and put a resolution that would extend additional aid to Israel for the war going on right now in Gaza. Of course, he's still got to deal with a lot of the budget issues out there as well, Katie Greifeld. It'll be interesting to see whether he's able to corral not just the Democrats onto his side, but more importantly, whether he's going to have the support of all of the members of the Republican Party, which is, of course, needed to pass anything these days, given just how narrow their majority is.
Yeah, absolutely. Obviously, Mike Johnson fought hard for this job, but maybe that's the easy part when you think about the tasks ahead of him, trying to build consensus in a very divided House, if you will, because, boy, do they have a lot on their plate right now.
Yeah, a very interesting day here. Remember, 22 days since the Speaker of the House, Kevin McCarthy, was removed. And, of course, a lot of uncertainty as to whether we would even see a new Speaker in due time. But still, an unprecedented gap in leadership for the House of Representatives, unprecedented in history. And now Mike Johnson has the weight of the Congress on his shoulders. Let's get back to the markets here as we count you down to the close with about 45 minutes until we get to those closing bells. David Bahnsen joining us right now, the Chief Investment Officer over at the Bahnsen Group. And David, let's start off here with some of the, I guess, shorter-term market moves that we're seeing, particularly on the day right now, where we're seeing a pretty remarkable sell-off going on. Some of this seems to be tied to concerns about the earnings that we've gotten and them not necessarily being supportive of current valuations.
Well, I think that's right, and I would point out that the Dow is only down about 20 basis points, and yet the NASDAQ is down, what, almost 250 basis points before the congressional press conference began. I mean, a day in which one index is down more than 10 times what another index is really indicative of how much the market was weighted and dependent upon some of these big tech names. Google's quarter wasn't this bad. I mean, the cloud revenue growth definitely underperformed expectations. But the problem was really the valuation. It's that if you tighten things up where the valuation is so perfect and you get even modestly bad news, this is the kind of response you get.
Yeah, absolutely. And I mean, no one's going to say this is a bad business or that it's not doing well here. But when you have that run up like we saw over the in the start of the year here, there's a lot that these companies have to show and prove. I am curious about the other side of this trade, David, and that's to do with some of the second tier companies and even some of the small cap names, which have never really seemed to gain any ground this year. And is that also out of fear, not so much of valuations, but of the structure of their business?
Well, do you mean the small cap index at large, or particularly those?
Well, let's talk about at large.
I think the Russell 2000 right now is close to a record level of non-profitable companies in the index. You have a small cap space that is somewhere between 40 and 50% money losing. It's unfathomable to me. I mean, you talk about one sector of investing that screams for active management, not passive. It really is small cap. And that's a big part of the problem is there's too many small cap publicly traded companies, especially on the tech side, that are unprofitable, and we're already coming with stretched valuations.
And David, that's a really interesting point that if you're an active manager, there's a lot of opportunity there in the small cap space. But you talk about that stress that some of those smaller companies are facing, and maybe you're seeing that in the Russell 2000 and other small cap benchmarks. But then you take a look at the debt markets, you take a look at credit markets, in particular high yield spreads, you aren't necessarily seeing that same level of stress. When do we start to see it filter out more broadly?
Well, we've been really focused on the fact that from 2003 to 2007, absolute yields were going higher and spreads really weren't until they did. And right now, absolute yields have obviously gone much higher, but to your point, spreads have not. It's remarkably contained. In fairness, defaults have also been quite low. I think a lot of companies in the high yield bond market had financing in place. They had sort of revved up their balance sheet during 2020, 21, low rate environment. They face a maturity wall. We talk about it a lot, both in the bond market and the floating rate bank loan market. There are more refinancings that will come due in 24 and 25. So far, I think it's been a byproduct of companies not needing to tap credit markets that much. And where some companies have needed credit, the private credit world has been phenomenal. Even if it's been at a higher cost, they've been able to go quickly and efficiently with these new innovations in private credit.
And David, when you put that all together and you think about refinancing risk, you think about the fact that you have a lot of companies going to the private credit market willing to pay up, wrap that all together into how you're positioning in your portfolio. When you think about the different stress points under the surface of the benchmarks here, where are you finding opportunity?
Well, so I'll say two things real quickly. One is that you can either conclude about this maturity wall and the future issues we face that things will get really bad later, or you can conclude that the Fed knows it too, and that the Fed will end up loosening monetary conditions before it gets to that point. That's my conclusion. I don't believe the Fed is really going to let a 10% default environment take hold. I certainly think there's going to be other collateral damage, but not to that core. But to answer your question, where we're positioning clients, I can't focus enough on dividend growth equities, very selective, because I don't believe you want to be buying big tech at 50 times earnings. And I don't think you want to buy an S&P 500 that only has 7 companies delivering all the return. Those cap-weighted index stories don't end well when it gets this top-heavy. History is very clear about that. So we're focusing on cash flow growth with strong balance sheets. And I think that there's going to be great opportunities going into 2024 in some of these names that have struggled this year in consumer staples, for example. In the meantime, energy is still doing very well. A lot of good dividend growers there.
All right, David, got to leave it there. Hope to have you back soon. Our thanks to David Bahnsen of the Bahnsen Group. Now, coming up next on the close in our Muni Moment, we'll talk with Chuck Peck. He is head of municipal products over at Wells Fargo. This is Bloomberg. Time now for our Muni Moment, and a Muni market that is on pace to record consecutive full-year negative returns for the first time since the early 1980s. Joining us now to break it down is Chuck Peck. He is head of municipal products over at Wells Fargo. And we think about potentially back-to-back negative returns. How much of that can we blame on the Treasury bond market?
You know, I feel like in the context of the municipal space, it's really a question of supply and demand. Yields have reached the point that it makes sense to be in the market, and investors want yields that are higher than inflation. Otherwise, you're eroding your savings. And we've been in this prolonged low rate environment that was great for issuers, but unrealistic and exacerbated by COVID. And the transformation was unfortunately painful because it happened so fast, but the pain trade is over. You know, I don't see additional spikes in rates given that inflation and growth is in check. And as you point out, we're 2 years back to back in a tough environment. And I think that 2023 in a lot of ways has been a continuation of a period of capital markets disruption that's not unique to the muni market. Depressed IPO activity, for example, a lot of anxiety around the commercial real estate space with $1 trillion of securities that need to be refinanced over the next 3 years. In the context of munis, the federal government has been pouring cash into the space, which has depressed demand. So I think there are a lot of unique factors at play.
Well, take us into 2024. Does that supply-demand imbalance come more into alignment?
I think it does. I think we're likely to start off 2024 in a similar place to where we are now. But we should expect some level of recovery thanks to a couple of factors, recessionary fears that are forcing state fiscal officers to think about reserving cash and keeping dry powder. Pension underperformance, of course, which are forcing public entities to use pay-as-you-go resources to fund required contributions.
But I understand there's a need for some of that. But when you consider the higher costs for these municipalities on an interest rate basis here, how much does that affect supply?
I think it's a deterrent. But at the same time, the shape of the yield curve makes funding projects more cost effective than before because you can reinvest your bond proceeds. Yeah. Same thing with refinancing transactions, which haven't been as popular lately because of the interest rate environment.
And this gets to a thing, too. I mean, I was looking kind of at, we have an index here at Bloomberg that kind of tracks the outlook for municipal issuance over the next 30 days. For most of the year, it's been pretty down, as I'm sure you know. But it's actually perked up recently here. It's not back above the historical averages, but certainly the expectations have come that we are going to see a little bit more of a supply come through the pipelines pretty quickly.
Right, and I think that's because there's a growing sense that we're done with increasing interest rates and we're going to be in a stable environment for some period of time. What we're not seeing is refinancings coming back yet, and that's really what's holding supply down.
Is there a calendar effect to this at all? I know most municipalities are on a fiscal year calendar, but is there a calendar year effect at all to issuance?
Technicals are strong at the end of the year and the beginning of the new year. And there are some nuances in the market where investors will start harvesting tax losses between now and the end of the year to sort of clean their books and start fresh going into 2024.
All right, Chuck, great to catch up with you here. Chuck Peck, he's head of municipal products over at Wells Fargo, stopping by today for our Muni Moment. A lot more coming up here on The Close, including a look at the Davos in the Desert, the big finance conference in Riyadh. A conversation coming up here with Professor Bernard Haeckel over at Princeton University, who says that signs at that conference point to Saudi Arabia aligning itself more with the West. That conversation up next. This is Bloomberg. Welcome back to The Close. About 30 minutes until we get to those closing bells. We do want to check in with David Weston, the host of Wall Street Week, who joins us every day for our Wall Street Week daily segment. And David, right now, some of the biggest bankers and financiers in the world are over in Riyadh for the so-called Davos in the Desert. Yeah. This is this big sort of conference that the Saudis set up, I guess, first to find a way to sort of invest their own money, but also as a way to sort of connect with the rest of the world, primarily the Western world.
Yeah, it was really integral with the major initiative of the Crown Prince over there to really redo the entire Saudi economy. So he did put together, as you say, Davos, it's called the FII. And we talked to somebody who's over there for it. He's Bernard Haeckel, professor of Near Eastern Studies at Princeton University. And he joined us from Riyadh, and we started with exactly how is it different this year, given what's going on in Egypt, or in Israel.
The FII is a very large sort of international gathering of financial, high flyers and companies. It's called Davos in the Desert. It's a bit like Davos, but very focused on finance. and it is an attempt to both market Saudi Arabia as an investment destination, but also as a country that can deploy its own resources in overseas investments. And it's extremely well attended, despite the war in Israel and Gaza. And there were fears that many people would cancel. No one seems to have canceled. So it's quite a circus. I mean, lots and lots of people, lots of talks, lots of networking. I noticed that there were very few Chinese there, which is interesting, that, the presence of certainly no Russians, but very few Chinese, which tells me something about, the orientation of Saudi Arabia being much more towards the West than towards the East, at least when it comes to investments. And the big question will be how many foreigners will invest in this country, how much foreign direct investment will come in as a result of FII. I think that's an interesting question. And then also how much Saudi will invest overseas as a result of it as well.
When the Crown Prince originally announced his remaking of the economy, Vision 2030, I think it's called, we spent a lot of attention on it. I wonder where it is now, how it's developed since then. And you make a very important point we may overlook sometimes. We think of Saudi Arabia as being someplace that has a lot of money to invest outside of Saudi Arabia, but also Saudi Arabia needs investment, as I understand, from around the world into its projects.
Yeah, absolutely. So Vision 2030 is basically a plan by the government of Saudi Arabia to diversify its economy away from its dependence on oil and hydrocarbons and petrochemicals, and trying to build new sectors that will prove to be profitable. So tourism, for instance, logistics, all kinds of manufacturing are sectors that they're developing. Those projects are ongoing. There are these what are called giga projects here, like NEOM and others that are still ongoing. They're extremely expensive, and the Saudi government will need to attract foreign direct investment to be able to complete these projects. And the vision also has a few other elements to it that have to do also with the transformation of the domestic economy and building kind of a better human capital and attracting people to come and live here. So you can think of the Vision 2030 as an attempt to kind of turn the entire country of Saudi Arabia into something like Dubai, a very dynamic, very forward-looking a country that will deploy lots of advanced technology.
So geopolitical risk is something all investors are taking into account these days. First with Ukraine, we've seen it, and now certainly in the Israel-Hamas war, as we're watching it unfold. Is it affecting the willingness of investors to invest in Saudi Arabia because of that instability and uncertainty in the region?
So we don't know yet, because we don't know what's going to happen in this war, whether it'll end quickly or it will be devastating and draw in other countries, most importantly Iran, into the war. So the Saudis are basically focused on building their domestic economy, and what they need more than anything else is stability. And they have tried to make a deal with the Iranians, a kind of détente agreement to try to lessen tensions with Iran. They've also tried to strike a deal with the Houthis, who are this group, non-state actor, guerrilla force in Yemen to the south of the border. They've also been talking about normalizing their relationship with Israel. So their attempt for the last couple of years have been to put out as many fires as possible so that they can get on with the business of building their country. And now a lot of that has just gone up in smoke because of what's happened on October 7th between Gaza and Israel. So the Saudis are desperate for this war to end as quickly as possible. They don't want a regional conflagration with Iran, and they want to get on with the business of building their country. And so they're trying very, very hard to work the phones, to deploy capital for the Palestinians in particular. They've come to an agreement with the Americans for that. And so they don't want to see chaos. They want to see stability. And there are forces in this region, most notably Iran, that want the opposite.
What about beyond capital? What about actually taking a leadership position in some of the Palestinian areas, the West Bank and in Gaza? Because it's thought that one of the big issues is not what Israel could do to Hamas, but who runs Gaza afterwards.
Yeah, and who actually leads the Palestinian Authority, because the Palestinian Authority which is effectively the government of Palestinians, is ineffectual, not liked, not popular with Palestinians. I think the Saudis are going to have to play a key role once this war is over to try to both help build up the Palestinian, capacity to govern better and to manage the Palestinian, but also to put pressure on Israel through the United States, principally, to come to a deal with the Palestinians. Because the one thing that this recent war has shown us is that as long as the Palestinian issue is not resolved with Israel, there will be spoilers like Iran, like Hamas, and others who will try to inflame the region, try to sow chaos. And the Saudis don't want that. They want what America wants, which is to try to end this conflict. And hopefully that can be done largely by trying to convince the Israelis that, it's been a long time and it needs to be resolved for their own sake, let alone for the sake of the whole region.
That was Professor Bernard Hakel of Princeton University coming to us from Riyadh, and I found it at least informative what the perspective is from Riyadh. They want this to settle this down because they're really worried about the economy over there and investment.
And it's interesting, too. It kind of shows you just the transition that the Saudi Arabia has made. I mean, it's just become too big, and economically speaking, to really sort of get involved in these types of issues, or at least to have them spiral out of it.
Exactly. We can hope at least they can be a force for settlement and relaxation over there of some of the tensions that we've seen. Now, tomorrow we're going to talk to someone you know well, Paul Romer. He's the Nobel laureate in economics. We're going to talk to him on the heels of those GDP numbers out tomorrow that are expected to be pretty high. And then on Friday, we're going to talk with former U.S. Ambassador to Israel, Tom Nyes. He just got done with his tour of duty over there, as well as Evercore founder Roger Altman. That's all coming up on Friday at 6 p.m. New York time.
All right, some great guests as always on Wall Street Week, and you can catch David Weston every day right here on The Close for his Wall Street Week daily segment as we round out into the final 20 minutes of trading here on this Wednesday afternoon. The good news is stocks are off the lows of the day, but still setting up for what is going to be one of their worst days of the year. Some relatively poor earnings that came out yesterday. That will be the setup as we head towards the close today with Meta, IBM, and ServiceNow on tap. Stick with us from New York. This is The Close on Bloomberg.
Well, the House of Representatives have found their new speaker, little-known Trump ally Mike Johnson. He's been elected after a 3-week succession fight. And for more, we're joined by Bloomberg News congressional reporter Mike Dorning. And Mike, we even heard Steve Scalise joke about people Googling who Mike Johnson is. So give us a little bit of background. What do we know about this man? What do we know about his voting record, for instance?
He's very much a hardcore conservative, both in terms of cultural issues and in terms of economic issues. He voted against the temporary funding to keep the government open to avoid the October 1st shutdown. He got his start, like even before he was in politics, he worked for a Christian right legal advocacy group and defended the ban on same-sex marriage in Louisiana before the state Supreme Court. So he comes both with very strong Christian conservative, cultural conservative credentials and with strong economic conservative fiscal hawk credentials.
Well, I understand why anyone who's a member of the Republican Party, or at least I shouldn't say everyone, but certainly a certain cohort, would be happy with this decision. I am curious about the idea that he is going to have to work with Democrats on some of these issues, given their slim majority. And I was taking a look at what Georgetown University and the Lugar Center over there put out here, saying that Johnson ranked 429th in bipartisanship in the House of Representatives. 435 lawmakers, Mike, as I'm sure you know, are in that chamber.
Yeah, no, he's definitely someone who, throughout his career, has definitely taken a voting record far to the right on the Republican side. That said, he's not this confrontational, combative personality like, for instance, Jim Jordan, who was nominated and failed to win Speaker. He's someone who has a more friendly, affable, outgoing style, particularly good at forging coalitions within the Republican Party. Now, we don't know how he will do trying to work with Democrats or with the White House. He's very untested in that. He's really only been in Washington for 6 years. And even when he has been in Congress, he was a very junior member of the leadership team, so he wasn't really involved in the broader negotiations.
There's going to be a lot of talk, of course, made about some of his cultural conservative stances here and whether that gets in the way of the actual real business that a lot of people here on the ground in the world, in our economy, really want to see, not to mention in the financial markets. I thought it was interesting, though, that he did highlight and made it clear that dealing with the nation's debt and deficit situation is going to be a big priority for him.
Yes, no, he went right to that point in his speech on the floor. He said that it was our greatest national security concern, the debt and government spending, and he said that they were going to have to make tough cuts to face the government spending and bring down government spending. So he's going to be someone who's pushing for deep cuts in these negotiations. That's going to put him in conflict with Senate Democrats and in conflict with President Biden.
All right, Mike, really appreciate the update and your analysis. Our thanks to Bloomberg's Mike Dorning. Now, still ahead, we're counting you down to the closing bell with Carin. She is Fiduciary Trust International Executive Vice President and Head of Portfolio Management, joining the show next as equities continue to deteriorate. This is The Close on Bloomberg.
This is the countdown to the close. Romaine Bostick here, joined now by Scarlet. She joins us every day at this time to help count us down to those closing bells and take us to the bell and beyond. Another busy day after the bell when we get some earnings. But I think it was the earnings from yesterday and this morning that really is driving the market right now. You're looking at an S&P 500 down more than 1%. And look at this, the NASDAQ 100, Scarlet, on pace right now for what's going to be its second worst day of the year.
Yeah, down 2.3% for the NASDAQ composite. And, of course, big tech is the reason why. You've got Alphabet's disappointing cloud results dragging down Amazon, which doesn't even report until tomorrow. Texas Instruments' bearish forecast hurting chip makers across the board. And Meta, which is reporting later on today, and by all accounts should be doing pretty well with advertising growth, also down before its earnings report.
Yeah, that's what I'm curious. Maybe that sets it up for a better rebound. Now that you have the downdraft down 4%, but we were talking a little bit earlier with Michael Morris over at Guggenheim. He actually said that, look, when you look at what happened with Google, with Alphabet, and their results here, that wasn't really about the ad business. That was about the softness that you saw in the cloud business. Yeah. So he's actually relatively bullish on what we're going to hear out of Meta tonight, saying that if Google's ad business is holding up, that certainly means that what Facebook, Instagram, and the other properties do is going to
right. And of course, that's, I mean, Alphabet, Facebook, Meta, is basically an advertising company for everything that it purports to be about the metaverse. It's advertising. It's 98% of its revenue.
I thought they were a magical tech company, Scarlet Fu. That's what they've been telling me for years.
Through advertising.
All right, let's get some insights here out of our next guest as we count you down to those closing bells. A little more than 8 minutes until we get there. Carin joining us right now, Fiduciary Trust International Executive Vice President, more importantly, the head of Portfolio Management. Carin, great to have you here. And I do want to start off with the earnings here. I mean, we talk about the Magnificent Seven and just what those sort of small cohort of stocks really meant to this market in the first half of the year, first 7 months of the year here. But now that we're starting to get some earnings out of Alphabet, not necessarily so good. And of course, last week, we heard from a couple of companies as well that also seem to suggest here, not so much that the businesses are doing bad, but they're not doing good enough to support some of the valuations from that run up earlier this year.
I think that's totally fair. So in terms of earnings and reactions, stock price reactions, we're definitely seeing companies, stock prices not really benefiting when they're beating numbers, whereas if they disappoint, they're getting really punished. So that's a sign that, perhaps a lot of expectations are sort of baked into the market. There's certainly a lot riding on technology earnings because we know that, they've been the largest contributor to earnings. And as we look to next year, they are expected to continue to grow and to drive earnings growth for the S&P 500. So it's really critical for the markets for these companies to deliver on earnings. And, as we're currently looking at just about 50% of companies reporting. Generally, I think, they are surprising a little bit to the positive in the aggregate. But, what we're looking for is really signs for any hints of a consumer slowdown, which we have been hearing from some companies about potentially a slowdown in consumers going forward in terms of the outlook. I don't think we're necessarily seeing that here for U.S. consumers, but we're definitely seeing more of that in terms of international markets.
Yeah, we've definitely heard from some, particularly for some of the luxury good makers like Carin and LVMH and a few of the other companies, seeing that they're seeing a market slowdown in those luxury goods. But we've also heard from a few companies that are kind of more mid-tier, saying that they're also seeing certainly a trade down by consumers to lower priced goods. And services.
Yes, I think for sure we're starting to see the differentiation in the consumer segments. And even some of the higher end, as you mentioned, is seeing some softening. I think higher interest rates, which should weigh on profit margins for companies, is also going to have an impact in terms of consumer spending. So I think that that's something that will be, that was an area of strength in the third quarter, but we thought that it was more due to temporary factors. And as we move forward, we expect to see softening.
It's interesting because we keep talking about this expected softening of consumer demand and consumer spending, but it isn't here yet. When you look at enterprise spending, that seems to be slowing down a little bit. We'll, of course, get a read from IBM later on today on just exactly how much we'll see or we are seeing. What does it say that enterprise spending is weakening more than consumer spending?
Sure. So we're definitely hearing companies talking about CapEx reductions, but I do also think that it's dependent on the area of the business. So we were talking about technology companies earlier, and I think that there are companies that are seeing some benefit from AI, and there's definitely some investment dollars going into AI companies. But aside from that, enterprise spending overall is softening. We're seeing some higher interest rates affect the financial sector, for example. We're seeing it starting to impact consumer spending, as we were mentioning, and that ultimately feeds into the outlook for companies in terms of how much they're spending. So I also see from semiconductor companies reporting that it's an indication that the economy is slowing down, and that's primarily due to softness in the industrials or in the manufacturing sectors.
Yeah, Texas Instruments forecast not helping the entire chip sector today. When we look at cloud companies, we talked about Alphabet and how the disappointing reaction in today's shares is due to the cloud business. Microsoft also had a good cloud business, or has a cloud business that did very well, and the stock is being rewarded for that. Which is more of a bellwether for the rest of the industry, Alphabet or Microsoft?
I'm going to have to say Alphabet, because it's a barometer of overall advertisement dollars, as well as cloud computing business that is tied to businesses. Whereas I do think that Microsoft has been benefiting from the investment dollars into AI and how it's benefiting their cloud business.
I am curious, though, about where people can find opportunities, because I don't think anyone wants to see a repeat of what we saw earlier this year, where everyone just bought, basically a basket of 10 to 15 stocks and ignored everything else in the broader market here. And I'm curious as to what the catalyst is, where you start to see a little bit more broadening out of market breadth. Are we still waiting for rates to settle down? Are we waiting for that economic all clear, we're not going to get the recession? What exactly are we waiting for?
I think we're actually waiting for the impact of negative interest rates to really fully get baked into the economy. I think the economy has been quite resilient despite the rise in interest rates. And that's, I think, what a lot of people are waiting for. When are we going to see cracks in the economy? Right, in terms of consumer spending, in terms of corporate spending, maybe there's some challenges from a credit standpoint in terms of funding. So we're looking at portfolios, and we really want to be defensively positioned here. We are slightly underweight equities from a risk standpoint. We're looking at a slight overweight in fixed income to try to take advantage of the yields. So, I do think that we're expecting some of those cracks to show, and that should actually weigh on investor sentiment and risk appetite.
Carin, it's great to catch up with you. Always a great conversation. Carin Pay there over at Fiduciary Trust International here in Studio 2 as we count you down to these closing bells with just about 2 minutes to go until we get there. Stock still right around, Scarlet, here at the lows of the day.
Yeah, it sounds like Carin is saying a lot of people in the market are looking for evidence to move things to the downside. You know, so far, if everything holds up, which it has been doing for months, it's not necessarily a reason to bid stocks higher.
Yeah, and it's interesting, too. I mean, we were talking about the effect of higher rates, and there was a great story on the Bloomberg terminal, actually written by Katie Greifeld and Eldon Hyrick, how it's saying that some of these companies that have big cash balance sheets are actually benefited from the hiring rates because, of course, you know, they're actually earning a return on that money, and it's actually providing a little bit of a boon. Of course, that's probably cold comfort given the negative impact that those rates has on a lot of other parts of their business. But it was kind of a curious point.
And it continues to separate those big tech companies from the rest of the market, right? It's another reason to fixate on 7 or 8 or 9 names as opposed to everything else.
Well, speaking of 7 or 8, 9 names, we should point out only one of the Magnificent 7 stocks is higher on the day, and that's Microsoft, which is up, I believe, about 3% right now. But you talk about some of the declines we're seeing in some of those other names. Of course, we know Alphabet down almost 10% on the day, but you're talking about a 4% decline in Meta, 6% in Amazon, 4% in NVIDIA, and Apple, which is the relative outperformer, only down a 1.3% here. And I'm just wondering what that really says or reflects in terms of investor sentiment.
Well, it tells you AI rules all. And I mean, does Apple have a link to AI? Sure, it's going to spend money on it, on Siri, but it's not quite the beneficiary that Microsoft is, as Carin was telling us. Tesla is even down as well, off by 1.9%. And certainly that's another company betting on AI self-driving vehicles.
Well, but this gets to the point, too, because we talk about why Alphabet's down so much. I mean, to remember, Tesla is on like something like a 10, 11% slide since its report. And that was also to this idea here that when people saw that profit miss here, they called into question the valuations. And you saw that with Alphabet as well. Microsoft bucked that trend because, well, guess what? You saw it. You saw the margins, you saw the profitability, and they still have revenue growth, and that's where people are gravitating to.
It's a show-me market.
Yeah, absolutely. I couldn't be said any better than that here. And a lot's going to have to be shown to us tonight as well as we get some big earnings out of Meta and IBM. Let's go through the numbers here real quick before some of those numbers begin to cross the wire here. A down day, to be sure, with more than 370 stocks in the S&P 500 lower on the day. A 1.4% drop for the S&P here to close out the day. This looks like it's going to be one of the worst days that the S&P has posted, going back at least, I believe, to the middle of the year. We're below that 4,200 mark, which is probably a more significant number here. Down 60 points on the day. 4186 is basically where we close at. The Dow Jones Industrial Average down more than 100 points, or about 0.3%. The NASDAQ Composite going to close out the day down 2.43%. The second worst day of the year of 2023. And the Russell 2000, not to be outdone, also down on the day, Scarlet, by 1.7%.
Yeah, you mentioned the S&P 500 lowest since earlier this year, since May 31st. So that is a 5-month low for the S&P 500. And here's how it stacks up when you look at the industry groups. That's a lot of red on the screen. All you need to know is at the very top, software and services up by 0.8%. That's Microsoft right there. Food, beverage, and tobacco and insurance companies also gaining, but not by very much. On the downside, media and entertainment off by almost 6.5%. That is Alphabet. Semiconductor companies, Texas Instruments dragging that group lower, and retailers off by 3.6% as a group.
All right, Romaine Bostick here alongside Scarlet Fu. Jess Menton joining us right now, who helps to lead our cross-asset coverage here at Bloomberg with a closer look at some of the big gainers and decliners here on the day. Jess, where do you want to start? You want to start with the good or the bad?
I'm going to start with the good.
Okay.
I'm going to point out what happened with Microsoft, because this obviously is another big tech growth name, the second biggest weighting in the S&P 500, just shy of Apple's weighting when it is over more than 7%. But when you see a stock like that, that's ticker symbol MSFT, up about 3%, so it's best day since July 18th.
Yeah.
If that stock hadn't held up, this pressure in this, especially the decline today, would have been far worse. So you are seeing that stock obviously on the back of what we did see with those better than expected results, which was a different story, right, than what we heard when it came to Alphabet yesterday after the closing bell.
Absolutely. Here, what else you got?
So I have to also point out one of the biggest gainers in the S&P 500, WM. So
I saw this. So that's waste management, right?
Waste management. Which
correct me if I'm wrong, but that's a trash company, right?
It is.
Okay,
it is.
all right.
It's Houston-based.
Okay.
Sanitation.
I just wanted to double check.
Sanitation,
yes.
Houston-based company.
I wasn't sure if that was some ironic name or something.
It's also an earnings story here. So those results did beat estimates, but then also the company did raise its guidance. A lot of that was driven because of free cash flow. So if you look at that stock, up 6% today.
Was that the biggest gainer in the S&P?
It was, yes, it was indeed. So best day since March of 2020 on that. So yes, especially when you are looking at a name like that, that's why why I ended up pointing it out, because it was.
And I'm glad you pointed it out too, Scarlett. Just I won't quiz you on this. The #1 performer in the S&P was Waste Management. Second was Travelers. The third was Westinghouse Air Brake, which I'm not even sure what that is. And General Dynamics. And you got to go pretty far down the list before you even get to Microsoft.
Yeah, right. And Microsoft had a 3% gain at that.
Yeah, and it was only
it's just the weighting, obviously, much larger when it comes to Microsoft. Over
Waste
7%.
Management isn't moving the market.
No, definitely not. But top gainer in the S&P 500. Then, of course, Gap. So looking at retailers, this stock up 5%, best day since October 16th.
Yeah.
So you are seeing. Actually, Wells Fargo did upgrade Gap to overweight from equal weight. So this has definitely been one of those inventory type stories that had been so many issues there, but they are more optimistic. They did raise the price target on that stock to $16 from $11. If you look at where it closed today, a little over $13. So that's something as far as just improving some of the cost cuts.
Well, it's a clean slate for the new CEO, I guess is one way to look at it.
Yeah, who came, and which point out he came from Mattel, which is like, you know, he has a halo around his head right now.
Mattel also reporting after the bell today, so we have to keep an eye on.
How about that for synergy? All right, let's go through some of the decliners on the day before we are awaiting earnings still.
Well, we have to point out Alphabet.
Yeah.
Because for obvious reasons, but we are looking at that stock dropping, and obviously when you see something like this, and one of the biggest weightings in the S&P 500, down 9.5%, worst day since March of 2020. So we do know that it's cloud unit. That's where we're disappointed. Smaller than expected profit. We clearly know how, especially when it comes to its search engine, that's sort of the main dynamic there. But as far as what it means for the future, a lot of that hinging on the AI story that I know, Scarlett, you talk so much about. And we know this is sort of the fervor there. So different story there when you're looking at Alphabet compared to Microsoft.
Also, Alphabet did pretty well since its last earnings report. So the bar was a lot higher for that company compared to, say, Microsoft.
It is. And that stock, just to point out, is up more than 40% year to date when you are looking at Alphabet. Another story on the chip space.
Before you move on to the next decliner, I do just want to point out we are getting some kind of secondary earnings crossing the wire already. And I do just want to point out one of the biggest decliners in after-hours trading is Align. Of course, that's the maker of those plastic braces, right? Yeah. Down 15% here on the back of their earnings coming out. It looks like a minor miss on net revenue and a minor miss on adjusted EPS as well. Sorry, back to you, Jess.
Looking at chip makers, so Texas Instruments, ticker symbol TXN, that stock down close to about 3.5% today, so it's the worst day since July 26. But if you look at the SOX, the semiconductor index for basically that, if you look year to date, close to 30%, had been up a lot more, but just to put in perspective, last year the stocks actually lost a little over 35%, so that was its worst annual decline since 2008. So you've seen that come back, but again today, when you're looking at chip makers broadly, not even just the big tech stocks, if we're thinking about what's happening with Alphabet, as well as Apple and some of these other names today, or Amazon, also the chip makers coming under pressure there. Yeah. So that one is a big one. And then I wanted to point out.
Can we stop you once again? We're breaking news show here, Jess. We got a lot going on. I mean, you were just extolling the virtues of Dickinson over there, taking over at coming from Mattel and going over to Gap here. We're learning the Mattel earnings crossing the wire.
Yeah, Mattel knocking it out of the park here in terms of the EPS number for third quarter. Adjusted EPS of $1.08. Analysts were looking for 86 cents on average. Net sales for the period, $1.92 billion. Analysts were expecting about $1.84 billion. Gross margin, adjusted gross margin of 51%. That is higher than what was anticipated as well. And in terms of the outlook, it sees full-year adjusted EPS of $1.15 to $1.25. Now, the consensus estimate is $1.20, so maybe, I mean, that matches the estimate, right? The midpoint of that range is the consensus estimate, but it leaves itself room to perhaps move it up even more next quarter.
I am curious when we're going to start to see more of a material boost from all the Barbie hype, right? I mean, the idea was that this was kind of the pillar for what's going to be a lot of IP that they're going to press out.
Next.
And you're smiling. Did you see Barbie?
I did.
Okay, well, guess what? I think they're doing Barney. They're doing the Matchbox cars or whatever they make.
And then, of course, they had this licensing deal with Disney, so that was the big factor. And especially because Citi's thinking that this will benefit, obviously, Mattel more than its rival Hasbro, because Mattel had in the past lost out on that licensing agreement, but now it has it back with Disney. So that's a crucial factor there when we're talking about, obviously, the Barbie movie, but then also what it means potentially for the consumer, and then some of the inventory headwinds they had last year during the holiday season. season, what that outlook is for this year.
Okay, I do want to go to some other earnings. And actually, now that you mentioned the consumer, so sit tight here, Jess. This is Whirlpool, Scarlet.
Exciting.
Yeah, I mean, the shares are down to 2% here, but I think it's interesting, too, when they talk about their forecast here. I mean, they're basically guiding for revenue on a full-year basis to about $19.4 billion. That's pretty much in line with estimates here. But when we talk about sort of the margins and the pricing power here, I think that's where some of the concern is right now. They're basically saying that their ongoing EPS is still going to be above estimates at $5.45 versus $4.25 here. But a lot of that has to do, I believe, with the tax benefit.
So it's interesting with Whirlpool because when do you actually buy these big new appliances? When you buy a house. There's no house sales transactions taking place right now. Everything's frozen with no one wanting to give up their sub 3% mortgages. And of course, interest rates really high as well. We just heard from IBM as well. So the big IT company, which will give us a read on enterprise spending. Third quarter revenue, $14.75 billion, better than expected. Analysts were looking for $14.68 billion. In terms of operating EPS, $2.20. Also higher than the average analyst estimate of $2.12. Software revenue was $6.27 billion, pretty much in line with estimates. And consulting revenue missing the mark. And this was going to be the weak link here. Anurag Rana of Bloomberg Intelligence had given a heads up that that was something he was focused on. $4.96 billion. Analysts were looking for north of $5 billion.
Interesting, though, the knee-jerk market reaction is to the upside here by about 2.4%. And I think you were asking, I forgot the guess you were asking, but you were talking about this a little bit earlier about IT spending and business spending, and whether that is actually as healthy as I think some of these companies want us to believe.
Right, because there's a lot of signs given that we've seen, and Accenture had given this indication as well that IT spending is slowing down quite a bit, along with Oracle and IBM. Of course, another read on that. That's enterprise spending, right? But then on the other hand, you have consumer spending, which people were expecting to see slow down, but so far hasn't really played out just yet.
Jess, and I'm curious, I get your thoughts too. I mean, I know you haven't had time to parse the numbers, but when we talk about this balance between business spending and consumer spending and its support for the economy, I mean, have investors sort of bought into this idea that both of those pillars of our economy may actually be softening just a bit?
Well, if you look at the latest update to the Atlanta Fed's GDP numbers for the third quarter, it actually stayed the same, but it was about 5.4%. Tomorrow, we actually get the reading on third quarter GDP numbers. It's supposed to be above 4%, and obviously really driven still by consumer spending, but then also exports are supposed to be a big component of those third quarter numbers. They're wondering what that would mean potentially for the fourth quarter, but from a seasonality perspective, that is typically historically the gangbuster consumer spending quarter due to the holidays.
And I'm glad you brought up that GDP number here, because when you say 4%, I mean, that's the economist estimates, obviously.
Yes.
I don't think anyone a couple of quarters ago would have predicted that.
Everyone's thinking
everyone was saying we were going to have a negative sign or at least a flat line in the second half. And here we are, third quarter, looking at 4%, assuming that actually is what the number is.
And you could take a look in the ECFC function in the terminal. So coming into this year, there was an expectation on a quarter-over-quarter basis that it would contract in the second and the third quarter. As we moved through the year, it continued to be pushed out, and now you don't even see that anymore on a quarterly basis.
This is like advanced terminal training here from Just Mentioned. ECFC,
I watch it very carefully.
Economic forecast, that's the function on the Bloomberg terminal.
Well, let's keep it going now, because, of course, we were just talking about IBM and, of course, the business spend there. We're now getting ServiceNow earnings crossing the wire here. Adjusted EPS coming in at $2.92. That's a beat over street estimates of $2.56 here. And the company saying that the adjusted revenue at $2.24 billion. That's just about in line with what the street was looking for. Here's your forecast going forward. Full year subscription revenue, $8.64 billion. The street was looking for 8.6, so relatively on the nose here. Those shares, Scarlet, higher by about 4% here in after hours.
Okay,
trading.
so for now, the software companies are getting a bit of a beat, and IT services companies, whether it's ServiceNow, whether it's IBM, it really points the spotlight at something like Alphabet, with the cloud business not doing as well as analysts had expected.
This is killing me, Jess. We're all waiting here for Meta platforms. I feel like we're all talking around it because they're supposed to be the star of the show. It's like Beyonce when you're just sitting there. And you're like, when is she coming out? And then finally,
no, it's like Madonna, because she doesn't show up until 9:30 p.m.
I know you're a star, but just come on. In all seriousness, though, we get to this idea of whether we're going to see a broadening out. Or when we have up moves, I should say, a broadening out of any of these rallies, or people are just going to gravitate back to what they feel is safety in terms of some of the big balance sheet names like a Microsoft here. Are we going to get enough out of these earnings this quarter that's going to give people a little bit more confidence to say there's more to life than just, Alphabet, Amazon, Microsoft, et cetera?
Well, when you look at the top 5 companies in the S&P 500, which are these mega cap tech company names that we typically talk about. On a year-over-year basis, they're actually supposed to post EPS growth of around 30%, so much higher than if you look at that preseason estimate for the S&P 500 down, contracting about 1%. But that does begin to level off next year, but a lot of that is just because the base effects and year-over-year is not quite the same. But because of the cost-cutting efforts, like say Meta, for instance, last November was when they first began that first tranche of big job cuts. We saw it again in the spring. So even the AI story with NVIDIA back in May, a lot of that efforts and what we saw with the stock prices was really boosted by a lot of the cost-cutting efforts and the improvement in margins, which actually bottomed more broadly for the S&P 500, and particularly the tech and growth companies at the end of last year. So how much more of that can keep going? It looks like when you're looking at the BI estimates, and Gina Martin-Adams and her team on the equity side of that thinks it can continue for the next couple of quarters, but next year, when you look on the fundamental basis, it starts to level out.
Do you think the big tech companies really had to, look at costs and monitor costs as carefully as they have been over the past year? Like, this was the first real big effort where they had to really take a close look at those costs.
Well, certainly some companies. I mean, even Zuckerberg. I mean, obviously he wouldn't admit this publicly, but when he talked about year of efficiency, I'm being serious. I mean, it was kind of an acknowledgement that that they hadn't been inefficient in the past.
Right.
We've seen this
we
also.
We could do whatever we want.
Yeah, and we've seen this with Salesforce and Mark Benioff. I mean, but in their defense, and I don't want to defend them, they could defend themselves, but in their defense, there was this idea that investors, and Jess, you know this well, that for several years, they wanted growth at all costs. They were penalizing companies not on profitability, not on margins. They were penalizing them whether that revenue growth came in light. And you had companies that at some point, even like let's take a ServiceNow, which is growing at like a 40-50% rate, and then all of a sudden they grow at like a 30-something% rate, and then their shares sell off. And so finally these executives have finally come around saying, look, this is insanity. We've got to refocus here, and I think you've got a lot of active investors out there that have made that case and put pressure on these companies like Salesforce to say this is what's important to us.
Or you're like a Netflix and you don't actually post the growth, and that's when everyone says, okay, now you got to show me how you're going to stay profitable.
Have you seen this movie? I think it's called Ruin or R-U-N. It's a Bloomberg Originals documentary.
Not yet, but I need to get on that later.
It's happening today.
It's happening today. Jess Menton, who leads our cross-asset coverage, she's sticking with us here as we try to parse a slew of earnings crossing the wire right now. Of course, the star of the show is Meta Platforms. We're still waiting for them.
The star's late.
Yeah, the star is late here. Definitely diva behavior. We don't get diva behavior out of our next guest, though. He is one of the best over at Bloomberg Intelligence. Mandeep Singh joining us right now, senior technology analyst. We brought you on, Mandeep, of course, to talk about Meta's earnings. They're not here yet, so let's give a preview of what you want to see or what you're expecting to hear.
I mean, the Reels number is huge. Last quarter, they said it's a $10 billion run rate. Everyone wants to know where we'll end up with that. And honestly, if you take out the Reels number, the rest of the business, and Reels spans across Instagram and the Blue app, the rest of the business is flat. So, and we know Reality Labs losses, everyone is fixated on that. How much money can they lose? They've already spent $50 billion on that. So from that standpoint, clearly, you have to ask yourself, if Reels is what's driving it, then, could there be an ad format that could disrupt it? And which is what ChatGPT is trying to do in terms of driving engagement through a new type of search, right? And Google showed yesterday that their ad pricing has gotten better. So clearly, they aren't the ones who are getting impacted by ChatGPT, but I think Gen AI is one trend that affects pretty much everyone in the internet arena, whether it's social media companies, search companies, and that's what I think we are looking out for. How well is Meta positioned?
How well is Meta positioned? Of course, Reels is driving a lot of that engagement, a lot of that monetization, but how sticky is that audience for Reels? Are they liable to go somewhere else if they're bombarded by too much targeted advertising?
I mean, the two big competitors. It's TikTok and YouTube Shorts. And YouTube Shorts actually did quite well.
You know what? Meta just came out with its numbers.
All right.
Romaine, why don't we go through the revenue numbers?
Meta Platforms are crossing the wire right now. 3Q revenue coming in at $34.15 billion. That's a little bit light. The street was looking for 33.5 $3.5 billion for the quarter. EPS coming in at $4.39. The street on average was looking, I don't actually have a comparison on that there, so I'll just hold off. But again, $4.39 on the 3Q EPS. Here's your forecast here. For the fourth quarter, the company is saying that it projects revenue of $36.5 to $40 billion. The street on average was looking for $38.8 billion. So the top end of that range would be a beat, or should it do that. Here are your monthly active users, Scarlet. 3Q numbers in the most recent quarter. Monthly active users coming in right on the nose at about 3.05 billion. And as far as the daily active users, that's coming in at 2.09, also, Scarlet, relatively on the nose there.
And when we talk about Facebook daily active users, that's the Blue app, right, Mandeep? The Blue app is still, I mean, as much as we say that it's slowed down and it's not like the driving force behind Meta, it's still a pretty big part of the company's value proposition.
Yeah, I mean, it's almost half of the revenue, although that revenue is sort of flat, but Instagram is the growing portion of the revenue. Mm-hmm. But Blue app is still driving, majority of the traffic and half of the revenue.
I do want to talk a little bit more about that, Mandeep, but I also want to talk a little bit about the costs and some of the issues surrounding that year of efficiency. Here are a couple other headlines to take note of. Meta says that it sees Reality Labs operating losses rising year over year for 2023. The company is also saying that it sees higher infrastructure-related costs in 2024. It sees growth in payroll expenses in 2024 as well. We should point out that for the full year, though, it is saying that its expenses are still going to be relatively in line with expectations at about $87 to $89 billion. Again, and another headline also crossing, and this is on Reality Labs as well, 2024 operating losses in Reality Labs will rise meaningfully.
Wow.
Mandeep Singh still with us here. And I do want to just touch on this issue just a little bit more. Basically saying that costs for Reality Labs in 2023 going to remain high, and they could rise even more in 2024. What do you make of that?
Well, so as I was saying before, they have spent almost $50 billion on Reality Labs, and we still don't have, a product that is margin accretive. So clearly they are losing money on every headset they are selling. And we don't know what sort of ecosystem they can create. I mean, there is no precedent of a hardware company actually overlaying social media content. Apple has done that. They've created the hardware. But the social media content and everything comes from elsewhere. So we don't have that sort of precedent. And I am very skeptical of the fact that they can create an ecosystem and be the hardware provider here. But clearly, they don't want to, back off on that.
Are they just throwing good money after bad when it comes to the Reality Labs, when it comes to the metaverse?
I think the challenge is the content. They can create the best headset out there, which they have. They're iterating on it. Quest 3, it's a low price point headset. Where do they get the content? Think of the app store that we have for Apple and Android, right? Where do you get the developers to actually develop for Meta first instead of Apple? Because Apple has a Vision Pro device now, we know that. And they will make it easy to develop content on the platform that can, stick to everything that they have on the smartphone side as well as the virtual reality headset.
All right, we're going to let Mandeep get back to work. Mandeep Singh over at Bloomberg Intelligence, senior technology analyst there, helping to break down Meta earnings. Those shares higher by about 4% here in after-hours trading. A quick recap of the numbers. Revenue coming in at about $34 billion. That's up about 23% from the previous year and above what the street was looking for. Advertising revenue also up about 24%. The family of apps revenue up about 24%. But Reality Labs revenue down 26% here and coming in below what the street was looking for. Pleased to say, joining us right now to give us a little bit more insight is Jeremy Goldman, Senior Director over at Insider Intelligence. And Jeremy, a lot to parse here. Let's start off with advertising revenue. I think we knew that was going to be strong. And at least at first blush at these numbers, they are strong.
Yeah, absolutely. I think one of the things that's really interesting is the story ahead. Can they actually open up more advertising surfaces? Because that's ultimately, it's just going to be very difficult to continually build on the existing ground. Places like Threads, right? That's something that a lot of people are paying a lot of attention to.
So we know that Meta, even though the Reality Labs project has not really paid off, and in fact, the numbers are going to get worse, as it points out, it has been slowly diversifying into AR, into VR, into AI. How specifically is that improving its ad business? How is it additive to what it does when it comes to advertising?
Well, one of the things that we talk about a lot is that there's a bit of a zero-sum game going on. So as a result, you really have to maximize time spent on your platforms, and you have to think about where time is going. That's where some of these investments with Reality Labs have basically come in. Now, the other aspect of it, I think, is just that if you're not investing, of course, we're talking about TikTok quite a bit. And TikTok is making a lot of investments to take that time away. So it's a bit of a proactive move, just simply because you have to do it at this point.
I'm glad you mentioned TikTok, because Reels is basically a version of TikTok, or Meta's version of it. And Threads is Meta's version of Twitter. And of course, Stories was Meta's version of Snapchat. So I guess my point is Meta's not exactly innovative. What it does do very well is scale up its different platforms to attract advertisers. Does that matter to investors, that it's not the leading edge of innovation, but it just does what other companies do better?
Yeah, I mean, I think it could be argued that just about every company that we follow in some ways, like cloud businesses, somebody started that. Other, companies like Alphabet started looking at them. So I think that that's one of those things that is a fair criticism, but at the same time, it's about how you actually execute. Threads, we've seen, it just hasn't actually attracted the amount of people that Twitter did. X does, even right now. It's about 4 to 5 times lower in traffic than it was right when it came out in July. And I think that that's probably a concern, because they do keep on innovating and throwing new features. But if you can't really create new ad surfaces, then how do you engage advertisers?
All right, great to catch up with you, Jeremy. Jeremy Goldman there over at Insider Intelligence. A closer look here at Meta Platforms. Those shares continuing to hold on to gains here in after-hours trading. But I want to bring your attention just real quickly to one of the biggest gainers in after-hours trading, and that's Endeavor Group. Those shares up about 11% here. And this is on the back of a confirmation by the company that they are exploring strategic options. This is interesting, of course, because, of course, Endeavor, relatively new to the public markets. And, of course, it just had that big tie-up with regards to the UFC and WWE into TKO. The talent company basically saying that it's launched a formal review of strategic options, citing a, quote, continued dislocation between its share price and what it believes is the underlying value of its assets. I'm a little confused by this, given that this is a company that is new to the market, and I feel like some of these issues maybe should have been strategically reviewed prior to coming to market, but I don't know.
You mentioned TKO Group. Endeavor will not consider the sale or disposition of its interest in that group as part of its review. So I read that as, we believe our stock should be higher.
That's exactly what Ari Emanuel is saying, and in no explicit terms here. So we'll kind of try to get you some more details on that story here, but that is the biggest mover in after-hours trading. Let's keep an eye here on another company that's been moving here on the day, and that is IBM. They just came out with their earnings. They're up about 2% here in after-hours trading. Revenue coming in at about 5% on a year-over-year basis, above analyst estimates. Anurag Rana joining us right now, Bloomberg Intelligence Senior Technology Analyst, to talk a little bit more about what we heard in the quarter here. Anurag, I mean, I'm going through the segments here. Software revenue up 8%, consulting revenue up about 6%, infrastructure revenue, though, down about 2 to 3%. What jumped out at you most?
Yeah, in fact, the infrastructure revenue is actually not as bad. I think people were expecting a decline of about 6% or so. The two numbers that really stuck out to us was Red Hat growth slowed to around 8% in constant currency. So that's first time ever I can remember back that it's not in double digits. And the consulting segment growth also slowed down. So I think we are seeing the impact of pressure on corporate IT spending here on IBM. Now, remember, there is some contribution from the Apptio deal. So I think the two offsetting factors are that the Apptio did add a little bit, but the infrastructure growth was not as bad as they had guided or consensus was expecting.
You mentioned the Apptio deal. When it comes to deal making, is there anything else that IBM would consider divesting or spinning off? I mean, it's already moved along weather and health businesses in recent years.
I think that's probably the most important question for IBM, and I would love to hear, if ever the CEO gives a better answer on that particular aspect, because one of the things we have seen with IBM over the last 3 to 4 years is ever since they have divested the slow-growing outsourcing business, their valuation has improved. Not too much, but it's improved compared to what it was a few years ago. And I think right now, all the good software assets that they have, they're kind of hidden in that, the rest of the services business. But, they've repeatedly said that it's a critical piece of the overall IBM equation, and they will not get rid of it. But I wonder the same exact thing, that if they were to get rid of it, would that help their valuation or not?
Yeah, it's interesting, too. I mean, I also am looking, just going through the statements here and looking at some of the commentary about AI and that whole Watson project and how that's being integrated into the broader business here. How much, if at all, do you think, Anurag, that will be a primary pillar of this company's growth?
It will be one of the pillars, but I can't call it primary for many years to come, only because, enterprise and AI is a very complicated problem to solve. I think they will gain a lot more traction when we see a rebound in IT spending on their consulting unit. IBM's consulting is one of the better ones in the market. It's known for both the higher end consulting aspect plus the execution or the implementation piece of it. So I see much more improvement in that in the long run. Mm-hmm. In the near term, we are expecting some pressure on that unit over the next 6 months.
Anurag Rana over at Bloomberg Intelligence, a breakdown of earnings out of IBM, better than reported sales and affirming its full year outlook here. The shares higher by about 1% in after hours trading. In just a second, we're going to take a closer look here at the results out of Meta. David Kirkpatrick going to be joining us after the break. Stick with us. This is Bloomberg. A dour day in U.S. financial markets today, with the NASDAQ 100 and NASDAQ Composite having their second worst day of 2023. That was on the back of some disappointing earnings results out of some of the big tech names, primarily Alphabet, which dropped more than 9% during the cash session. The S&P 500 not spared either, down about 1.4% on the day. And you take a look at some of the sub-indices. The Philadelphia Semiconductor Index down about 4%. And you also saw similar declines in some of the other pockets of this market, from energy to financials and everything in between. An uptick in yields on the 5-year and the 10-year, causing some concern here. An uptick in the VIX and an uptick once again in the dollar, also reminding investors here that this is still a macro-driven market. Despite all of that, the focus is still on earnings that are still crossing the wire fast and furious. Whether we get a boost tomorrow morning, Scarlet, is going to depend largely on how investors interpret the earnings that we just got, including out of Meta Platforms.
Yep, and let's go to Meta Platforms, because the stock right now is moving higher in after-hours trading after giving numbers that pleased investors, particularly when it comes to advertising. And of course, Meta has been a stock that's been on the rise. It has the second best performance in the S&P 500 this year. Joining us now is David Kirkpatrick, founder of Techonomy Media and also author of The Facebook Effect. So, David, you had noted that Meta would pretty much have a great earnings report by conventional measures, and that's what we got, and the stock bears that out right now.
It was a smashing result. I mean, it is, sadly, or bad. Whatever you think about them, they're doing great financially.
They're doing great financially, but I want to talk to you about what's going on with the company when it comes to its influence on society at large. We had more than 30 states sue Meta this week for exploiting youths, they say, for profit and feeding them harmful content through the likes of Instagram and Facebook. And of course, these things will take years to sort out. I mean, there's going to be lawyers' fees up the wazoo. Have investors just come to accept this as part of the cost of doing business for Meta and look past it completely?
Well, it makes me sort of sad to say so, but I think Wall Street doesn't really care about social harms, especially when it comes to internet companies. And, this issue of the harms to teenagers was one of the central revelations of Frances Haugen 2 years ago. Mm-hmm. So it's not news, but it's being documented more and more effectively and thoroughly. And I think that's one reason why 41 states and the District of Columbia have sued Facebook, Meta, because of particularly harms on Instagram, but other platforms as well, the teenage self-image, suicide risks, etc. These are serious problems that the company has not sufficiently addressed. And it's just one of a number of categories of things that they haven't really addressed.
What else have they not addressed?
Well, they haven't really addressed misinformation at the scale that it needs to be tackled. I think many people are very worried about the election coming up, and they have effects on elections all over the world, and they're not managing it that well.
I am curious, though. I mean, you say that Wall Street doesn't care, investors don't care, and obviously they'll care if it proves to be a material impact in their business, but we could have had this conversation 10 years ago about Facebook and its properties, and nothing's really changed.
That is sadly true.
Yeah.
I don't think that Zuckerberg cares that much about remedying social harms. I think he thinks he does, but he doesn't really want to spend the money on it. Yeah. And he has such a semi-religious belief in the virtue of this platform and the macro scale, what good it does for society, that he thinks all the little problems are really quibbles that we shouldn't give him a hard time about.
Can he count on? Oh, sorry. Can he count on AI to do some of the work for him in addressing this?
He is getting AI to do some of the work for him, and that's to their credit and to the industry's credit. AI is definitely improving in its ability to detect all kinds of subtleties that, of course, as we know, never could do before. The subtlety of AI detection and monitoring of all sorts of systems has taken a huge leap in the last few years. So I do have some degree of optimism that as they point their extremely high-quality AI tools at these problems, they will get better. And I'm sure they're catching a lot of stuff. But there's a lot of things they need to do in terms of giving users more control that they have failed to do and haven't really put a priority on.
But if I want to play devil's advocate here, there would be some people who would say, why is this Facebook's responsibility to do some of this stuff?
Right.
I mean, they're saying, look, we're here to do business. We're here to make money. And as long as we're not, polluting the environment or doing something that's in direct violation of the law, that's more for regulators and for legislators to figure out how to sort of put up those guardrails to protect our youth.
I don't think that kind of a logic makes as much sense when it comes to a media company. Okay. I mean, I'll give you one big example.
But whoa. He'll tell you he's not a media company. He'll say
that, but he's wrong.
Okay, go ahead.
I mean, Facebook and Meta, Facebook operates in 120 countries or maybe 200 languages. And they went into most of those languages headlong with no employees who had any knowledge of the language, with no oversight, no governance whatsoever. And in many of those languages, that remains the case.
Yeah.
So to me, that's irresponsible. It was very growth beneficial for revenues to have all those people in all those languages and countries, but they didn't really think about monitoring it or managing it or being responsible.
But there's a big difference, David, and Scarlet, you know this too. We talk about a media company. You have a media company that is producing the content and saying they have a certain responsibility to make sure that content is accurate.
It's a different kind of media company.
But Facebook will say, we're not producing the content. Yes, they're hosting it. Yes, they're doing that, but we're not. We're just a reflection of what's going on in society.
And that is the case, but we've seen in the past, Twitter, now X is not doing this anymore, but some kind of moderation role in terms of...
Well, Facebook does a ton of moderating. I'm just saying they're not moderating enough in all the right places.
Yeah. So this brings me to my next question, which is Threads. Threads was unveiled to a lot of fanfare. It's kind of lost traction. No one really talks about it anymore. I mean, they might have big numbers because they imported everyone over from Instagram, but as long as Meta or Mark Zuckerberg doesn't take this idea of it being a media company seriously, can Threads ever really gain traction?
I don't think it is a matter of whether he takes media seriously or not. I think Threads does have some potential long term, especially as we see Twitter immolating by its own. Musk is just really doing everything he can in many respects to undermine the trust that many of us had in Twitter. So I think the existence of an alternative put out there by Meta could be a real virtue for them long term.
Not that it's doing anything right now, though.
No, it isn't doing that much now, but I think it could. I wouldn't write it off.
All right. Well, David Kirkpatrick, really appreciate it, and we'll have to bring you back on next time.
I love being here. Thank you.
Meta headlines. All right. David Kirkpatrick is Techonomy Media founder and author of The Facebook Effect. And Romaine, we're also keeping an eye on the Japanese yen as well. It's weakened to match its low for the year, and of course that raises all kinds of questions about whether the BOJ will step in.
Well, it's now exceeded that low for the year, 150.31, as we've been speaking here, and of course that could end up being a big story going forward. Of course, we talk about whether the Bank of Japan will intervene. I mean, we know, of course, they stand on the sidelines trying to watch and sort of pick their battles here, but something that could sort of be another market mover tomorrow.
Who needs a Fed in this day and age? I'm only saying this because it's in the quiet period. That's all.
The quiet period here. All right, well, no quiet period for Mattel. They just reported earnings here, and the shares are down pretty hard in after-hours trading. The results themselves were good, but the outlook may be causing investors some concern. The Barbie effect coming up next on The Close on Bloomberg.
I'm so grateful and so humbled to have gotten a unanimous vote on the floor by all of my colleagues here. We went through a lot to get here, but we are ready to govern, and that will begin right away.
And that is Mike Johnson. He is your new U.S. Speaker of the House here, of course, after the three previous candidates effectively either dropped out or didn't really gain any traction in voting. And of course, that comes after the ouster of the former Speaker of the House, Kevin McCarthy, at the start of the month. Terry Haines joining us right now, the founder of Pangaea Policy, to talk a little bit more as to what we can expect out of Speaker Johnson here. I thought it was interesting in the speech that he gave a little bit earlier. I mean, he did talk about his own, cultural values, which we know he is a cultural conservative. But he was also very quick to point out this idea that he wants to make dealing with the budget, dealing with deficits and debt a priority for his party.
Well, yeah, he did, and he should, because a lot of the people that elected him to the position are exactly the sort of people that want to tell you that that's their main focus, or one of them anyway. The way I would suggest the markets look at it is this. I mean, it's a small market positive that, we actually have a speaker and the House can continue to govern now. At the same time, what you've got here is a situation where over the last 3 weeks where, three major figures in the House Republican Party, Majority Leader Scalise, Majority Whip Emmer, Judiciary Chairman Jordan, each got taken down a peg by their own caucus, essentially, by having that caucus not agree to make them speaker. So the air was let out of the balloon a little bit. With Johnson as kind of the compromise candidate, now those balloons are somewhat reinflated. So what you're really going to see is people like Scalise and Emmer and Jordan much more empowered than they were. This is not the kind of speakership where Johnson's going to be the spear on things. That's going to be other figures in the party.
Who do you anticipate to have the most influence over Johnson? I know that he's called Jim Jordan one of his mentors.
Well, I think he listens to everybody. It's going to be his job, as well as Scalise's, since Scalise is the majority leader, to try to knit together consensus. And we've all seen in the past 10 months just how fragile that consensus is on the Republican side. So they're going to have a job in front of them, and he's going to have to listen as much or more to the centrists in his party, including those who come from New York, New Jersey, and the metropolitan area, because they actually are the majority. And, I thought they came out of this smelling pretty good in the end. They didn't get steamrolled by conservatives. And I imagine a lot of conversations took place on what their priorities are, too.
Right. They held out and they got what they wanted in that they didn't have Jim Jordan be elected speaker. So Johnson this week,
I think so.
When it comes to his number one priority, it is, of course, to get us past November 17th, right, when the government could ostensibly shut down. This week, Johnson did back a temporary spending plan to keep the government open past that deadline. If Kevin McCarthy was ousted for playing ball with the Democrats, preventing a shutdown the first time around, will that same fate befall Johnson for coming up with a continuing resolution?
This time, I think it's not anywhere near as likely because frankly, of what happened over the last 3 weeks. The House Republicans proved a number of things over the last 3 weeks, one of which is that they found it difficult to walk and chew gum at the same time. So they've made really no progress on spending bills that they really need to make progress on in order to forestall yet another CR. Now, the vast majority of people in the party are saying, well, hey, look, we need some more time here, whether it's the 1st of January or the 1st of April, as I think you said before. And, so they're going to have to figure out exactly how long they want a CR for and how long it's going to take them to put appropriations bills together. That's job one. Job two is going to be the Israel-Ukraine border package, and I think that takes till the end of the year as well.
Yeah, and we should point out he did say on the steps that he was going to walk right back into the House and vote on one of the resolutions here that the Republican Party had put forward with regards to the spending for Israel here. Longer term, though, I am curious, is he basically effectively going to be the leader, the House leader, I should say, of this party here? I mean, we know that this was he ended up in this job primarily because, everyone hated everyone else who was vying for the job here. But do you think he has not only the tact as a leader, but the support, not just among the hard right, but really among some of those centrist Republicans to remain in this role, assuming that they hold on to control of the House?
Well, the way I look at it, Romaine, is this. I mean, he's a leader, but he's by no means the leader. He's going to be somebody that is going to be one of the people in the room, but the rest of the people in the room are going to be the elected leaders from the beginning of the Congress, Scalise and Emmer and Elise Stefanik, and as well as committee chairs like Patrick McHenry and others. And McHenry, I think, is further elevated his status here by serving as temporary speaker and doing it in a way that didn't really unduly damage the House and certainly buttressed McHenry's own reputation. I think Johnson is a voice, but by no means is this Johnson's party or Johnson's the leading figure. That's not at all what's going on here.
Yeah, yeah, of course, Scarlet, when you consider that it was basically Trump who kind of swept in and said, I don't want Emmers, and he basically told him who he wanted, and it seems like we have him.
All right, so the circus slows down a little bit in Washington. We'll see what the next show is, right?
Okay, I think the circus will pick up pretty quickly.
All right. Terry, thank you so much. Terry Haines of Pangaea Policy, they're joining us there on the new Speaker of the House, who has, of course, just been elected today by his colleagues. Meanwhile, let's get back to earnings. Mattel, the toy maker, coming out with numbers, at least in the third quarter, which blew away estimates. Adjusted EPS at $1.08. Analysts were looking for 86 cents. Net sales of $1.92 billion also beat the consensus. As for the outlook, it wasn't terrible. In fact, they maintained a lot of their forecasts and slightly raised higher their full-year adjusted EBITDA outlook, and also sees the full-year adjusted gross margin of 47 to 48% versus the previous 47%. Let's now bring in Lindsay Dutch, Bloomberg Intelligence consumer hardlines analyst, because, Lindsay, I'm looking at the stock price in after-hours trade, and initially, Mattel rose after the announcement, but now it's down about 6%. What within the outlook disappointed investors?
Right. So as you mentioned, third quarter, everyone was looking at Barbie. That was what was the headline number. Gross billings rose 16%. That was pretty good. Dolls as a broader category was even more impressive, 27%. But when we looked at the outlook, sales, the forecast is flat year over year, unchanged from 3 months ago. And when we think about margin, at best, 100 basis points better, and EPS just 5 cents better. So, overall, when we think about the outlook, as good as Barbie did in the quarter, and as much as I believe that momentum is continuing into the fourth quarter, the outlook overall was disappointing.
I am curious, too, if you could kind of explain, when you talk about the business of Mattel, the traditional business of selling these toys here, I mean, how much does that hold up when economic conditions are tight? Because when I think about toys, I always think, to a certain extent, at least for certain families, that's more of a staple than a discretionary item.
Yeah, that's exactly right. So typically in difficult times, parents are still during the holiday season going to focus on getting toys for their kids. And when you think about Barbie too, the price point is pretty low, and that is good for this type of environment. But it might be the difference of getting one doll versus two. Similar with Hot Wheels, right? You might get one car versus like the pack of 6 or 12. So I think that it's really, there could be pressure on volume in terms of how many of the toys, whereas parents will continue to make sure that they have something for their children during the holiday season. We do see positive momentum heading into the holiday season. I've heard Barbie and Ken is a top Halloween costume. I think that's great heading into the shopping season. So I do expect a strong fourth quarter for Barbie itself.
Barbie and Ken. Is that where we're going at, Scarlet? Yeah.
Yeah, we could totally do that.
All right, Lindsay Dutch over at Bloomberg Intelligence. A closer look at Mattel here.
Are you beach, Ken?
Some pretty decent. No, I'm nobody. I think there's some pretty decent numbers out of Mattel, at least for the quarter. But again, I think people really wanted to see a better bump up in that forecast, given all the hype around Barbie and that everybody's going to be walking around. Well, and we should point out, I think the Barbie and Ken thing is over. It's all like Travis and Taylor. Those are the costumes for the thing. Thank you very much. So unless Mattel can capitalize off that.
That'll be our costume this Halloween.
All right, let's make a quick pivot here over to the travel space here. There's been a lot of talk here about Wyndham Hotels and Choice Hotels. Of course, Choice offered to pay $90 a share in cash and stock to buy out Wyndham. Wyndham basically saying that's not going to happen. Choice, just over the last few minutes since those closing bells rang, says that it is calling on Wyndham to engage in talks and said that it's ready to move expeditiously on this deal and urges Wyndham to negotiate. Not really seeing a response yet from Wyndham. Let's get some insights out of Jody Lurie, Bloomberg Intelligence credit analyst. And I mean, you know, I understand why Choice might be sort of keeping mum at the moment here, but do you think that what's been put on the table from Wyndham might be attractive enough at least to get Choice to negotiate? Or vice versa, you know, sorry. I got confused.
Yeah, I think it's a complicated situation, Romaine. And I think, you know, Brian Egger, my equity counterpart, actually nailed it on the head where he said that from an antitrust standpoint, there's definitely a lot of risk in terms of getting the deal to move forward. These companies sort of corner that lower end market of hotels. And while you have someone like Hilton and Marriott going into it, there's still not a big dent into that area. Hilton actually just reported this morning and had pretty strong results, was pretty optimistic about next year. But definitely they haven't so much as skimmed the surface into the area that Choice and Wyndham are in.
Yeah, and given the regulatory climate, it makes total sense for there to be caution when it comes to antitrust concerns. In rejecting Choice's offer, Wyndham's board also cited high debt levels. Can you give us a snapshot of what that looks like for the company?
Yeah. I mean, I think it's pretty clear when Choice is saying, hey, we'll finance it 55% with debt. Wyndham, I don't think, or they said 55% with cash, which usually when you say cash, you mean debt. They don't have that much cash on the balance sheet. So that's about $4 billion that they would take on in addition to the debt that they already have on the books. And so the rating agencies were pretty clear last week that it's unlikely Choice would stay investment grade if it went with this transaction. Now, interestingly, Wyndham's already high yield. Management has indicated to us in the past that getting to investment grade isn't really a goal of theirs at the moment. But that said, the combined company having so much debt and also being high yield in an environment when rates are rising isn't necessarily the most savory of situations.
Yeah. All right, going to have to leave it there. Jody Lurie, senior credit analyst over at Bloomberg Intelligence. A closer look here at that Choice Wyndham deal that, at least for right now, has never came to be. And tomorrow, we're going to have a closer focus on the close here on the travel sector with Naftali Holtz, the CFO over at Royal Caribbean, on the heels of their earnings. You definitely want to be sure to tune in for that tomorrow. Meanwhile, here on the close today, we're going to set you up for some of the other big potential market movers in the 24 hours ahead. Stick with us. This is Bloomberg. A lot of potential things going on over the next 24 hours that the market will have their eye on, including the release of that documentary, Are You In?, about the Sam Bankman-Fried trial, which still continues in Lower Manhattan.
Yeah, and in fact, Sam Bankman-Fried might be testifying as early as tomorrow. Stay tuned.
We got a big ECB decision. Christine Lagarde going to give us her outlook here on rates and, of course, the big news conference. And then we come back here to the U.S. We get some big economic data.
GDP for the third quarter right now, the consensus estimate is for 4.5% growth.
Did you have 4.5% earlier this year? I think if we get that, that'll definitely be us big. We're going to get some more housing data, and we're going to get a lot more earnings, including before the bell from Volkswagen, Mercedes, First Citizens, and UPS. And then after bell, Scarlet, a slew of companies also scheduled to report.
The last of the Magnificent Seven reports, we're talking about Amazon, also Intel, and Ford and Chipotle.
All right, thanks for watching us today. So you definitely want to tune in tomorrow. Scarlet and I will be back with full coverage of all those earnings.